Okay, guys, very good morning. I'm Chavan, the host here. We'll be starting the webinar now. This is going to be a very good webinar, so please do stay till the end. Rohit will be presenting his presentation now. He'll be starting his presentation, and after that we'll have a Q&A session also. So yeah, let's start. Rohit, it's all yours. Thank you so much.
See, today's entire talk, it's not just going to be about presentation as it always is in my case. We're going to look at a lot of charts. I'll probably open my software apart from some charts that I find around the web and on the report. But the real idea is to get the message across. I think very important to understand where we are in the market, what is the risk. I think highly underappreciated level of risk out there. And also for those who are new to the community, knowing how we got here and where we came from, because specifically when I put out views and there are contra opinions, and some people will come up and say, oh, you said this or you said that. I think it lacks context. And so I'll put the context and then we are of course open to any kind of critical thinking in that context, but I'll tell you where I am in this entire flow. See, for us, I think Indiacharts, of course, has been around as a blog since the year 2000 with a single focus of sharing the best quality analysis, which initially was mostly charts, technicals, and I had the thoughts of combining economic theory with it. I didn't do it on day one. I took, I think, at least a 10-year period to finally start sharing what was known as the quantitative cycle reports. And they were essentially based on the economic cycle in combination with Elliott wave analysis. And then while I had modeled the value wave theory, I put that one page, I think, on the old Indiacharts site. I never really explained it in detail. And then when I made Indiacharts live in 2013 as a paid newsletter, then I started sharing ideas under that specific, category, as we may call it now. Because then you're clearly highlighting one more application of Elliott wave analysis, which is when you combine it with the long-term value of that you see in a stock, which is sort of a combination of Elliott wave with fundamentals. So and works very well in the bottom-up approach. See, it doesn't really work in the top-down. So what is top-down? So if you're in the area of fundamental research, top-down means you first study, the sectors, then you look at the stocks. So that is top down. So you start from top, look at the market, look at each of the sectors, and then you look at individual stocks within the sector. Whereas bottom up is looking for individual companies that can provide value. So these are very different approaches to the market. And my sense is while top down serves the purpose of covering maybe 1,000 companies, which individually none of us can really invest in at the same time, bottom-up really has the approach of trying to find the dirty dozen, which you really want to stay for the long term. And of course, there can be many more outside your basket. Humanly, we cannot cover everything. But then humanly, you cannot even invest in everything. Your portfolio will rarely be larger than 10, 15, or 20 stocks. I rarely cross 20. When I cross 20, I know I'm going to get into trouble, which means I own too many, or maybe the stock market has gone up so much that I'm owning junk. And usually it's time to cut back and reduce the size. So that's how it works. So I don't know why we should not be able to fine tune down to the best 10, 15, 20 stocks that you want to own from an investment perspective. And then there comes the trading part. Trading, a lot of people think is really, it's the devil's game. If you're a long-term investor, it's something that you don't get into. There are a lot of people who, even as traders, don't play the short side. But for me, it's everything. I mean, and that doesn't mean, when I say everything, it doesn't mean it's everything that I do. But if you study the history of any big investor, at the very start of his investment journey, many times there is some amount of trading. So the reason for that is that a lot of individuals who come to the market want to initially build capital. And one of the ways they see as an opportunity to build capital is to actually do some trading and build capital, then become an investor. And that's a journey. A lot of people have followed it. I think from the likes of, in India, I would say Rakesh Jhunjhunwala would be a reflection of that, who does a combination of both. Globally, you would think of people like George Soros, who's taken big trades, made billions on the pound bet, which is so well marketed as an idea that he did. But apart from that, mostly been an investor. So there are these mix of things people do, and the way they do it is never looking at one part of the science. So I didn't come to the stock market to get a job as a research analyst. That was not the approach. Of course, you like working in industry to be able to provide some kind of service and enjoy doing what you do every day, which is market analysis. But I really thought of the market as a place that I wanted to make money. So I always give this story. I was probably 18 in 1990, 11th grade or something, when I started to look at the markets. And the interest was that once I got to know what markets are all about, how do you make money, which meant that you have to study everything. So I was not told that you need to look at charts to make money. You need to make money means you need to know technical analysis, fundamental analysis, and economic analysis. So there are three different areas of study, and you need to do them. So I have spent my time trying to study all. Sometimes people get boxed into thinking that you only to look at one. There are both shortcomings and advantages of doing the entire basket. The shortcoming is that if you're only looking at one aspect, then you're missing out on the other. For example, a lot of fundamental analysts also look at charts in India. India is the only place where we down talk charting, and look at it, hiding behind the screen. This is the only place in the world that happens. Around the world, everyone openly talks about it. But the beauty is that it tells you about demand and supply and longer term trends as well. It's not only a short term trading tool. And in combination, everybody's used it over time. And so when you do that, it sort of helps you have a gauge of timing when you need to do your investments as well. And so it sort of solves the problem of why do I do a SIP? Unless you're at a very early stage, you're doing a SIP where you're doing a small amount of money every month. If you're really doing quantum investing, and once your SIP value grows, fine, you started at 10,000 a month. Now it's suddenly 5 lakh rupees. Then does timing matter? So you might say at 5 or 10,000 rupees, it didn't matter if the market fell 50% because it was barely any amount of your total savings in the long term. But once that 10,000 has reached 5 lakhs and the market falls 50%, would you be happy? And so saying that you can ignore timing is just ignorance at bliss. So, and then there's a third factor, and this one comes at large at times like this, like the times we are in today, where if we say that macroeconomics doesn't matter, or macro, as we call it, we don't even use the word economics now. In the global hedge fund community, it's all macro. And if you end up in a situation where macro is the main driver of what's happening in the market and you've been ignorant, then you miss out on what is known as mega trends that are going on. And this works both ways. Some people think that macro or technicals are just to go short, or specifically Elliott wave, which is again not true. Because if it was not for macro, then it wouldn't have been the reflation trade that we wrote about in May of 2020, 2 months after the market bottomed post the pandemic, citing that you had a big move coming up in the commodity space, right, which has led the rally in metals, etc. So you get insights about what is really happening in the world by studying all of that, and that's how I take my view. So my approach always has been as an investor trader, no matter what role I have played in industry and what name people want to call you by, because that's their shortcut of getting over their innovations or insecurities. Frankly, I don't care what people think. I just know that I need to use the complete market science to make money. Call me whatever analyst you like, but whoever works here, like we think of ourselves as market analysts or market strategists, which is broadly understanding what is happening and then taking a view on what's likely to happen in the future. And so that's sort of the setup with which the long short report is also written, studying all aspects of the market, whether it's domestic equity, global equity, what is happening in macro from interest rates to the dollar, and then looking at sentiment, which is an important part of the Elliott wave angle, and putting it together in terms of where we probably are placed, and also being willing to change that view with whatever criticism it takes, because eventually changing your view from one camp to the next is the most important in being able to take a decision to stay in the market, exit the market, change sectors, focus on a specific area. If the narrative changes, you need to change your narrative. You cannot stick to one narrative and try to sell the same game over and over again. That's not what we are in, and that's also a reason why I have zero intention, and I say that again, zero intention of running any kind of services which are regulated in nature, which means I'll never run a mutual fund portfolio management service or AIF. So if anybody is hoping that happens at some point of time, the answer is 100% unlikely. And again, reason for that is conflict of interest. I don't want to be running something which is simply based on gathering assets and I'll earn 2% yield on your money. That makes no sense. It fails the entire objective of everybody should learn how to make money. So we position ourselves as an educational firm. The reason we do that is when we share analysis, we are hoping you learn from it and you learn to execute it. Because one thing is to tell you what I think the market is going to do, and it's another thing to really execute that view. Some people might think the view and execution are one and the same, which is again not true, because execution really requires a skill set of includes a skill set of money management, position sizing, doing what I talked about right at the beginning, which is splitting into how many stocks are you going to own, how much are you going to put in each one of them, and is it going to simply be equal, or you're going to have a higher bet size on some of the items versus the others, and based on what logic are you going to really do that? So now that's a completely different part of science, apart from just saying that you're bullish on the market or you're bearish on the market. So having the process to be able to execute, not just on a portfolio level, which is the investment part, but also on the trading level. Sure, you can trade to build capital, but once you've built capital, trading eventually will become a smaller and smaller portion of your overall portfolio. So while it would have been 80% of my activity, say in 2002, today it's 20% of my activity. So I don't allocate more than 20% of my capital to trading. As it grows bigger, I could even reduce it. That's a choice I have to make. I've not made that switch yet, but I can. But again, if I continue to do it, and why would you do it? If you can make money as a long-term investor and you've gained capital size, why should you continue to trade? And the reason might only be to serve a bigger purpose in terms of being able to communicate that with people who are just starting out. So that's, I think, one way it helps. So that is it may serve that larger purpose, but there's also a inner purpose that it keeps me in tune with what the market is really doing. So if I didn't do it, if I didn't have a longer short position at all points of time in the market, I wouldn't have that feel of what it is really doing. So I strongly believe in having my hands or what we call skin in the game, right? Without having skin in the game, I don't think anybody is in a position to really advise anyone what they should be doing, and we don't even give advice. So my best way, and there's a reason for that as well, I have found in my years of working with Sher Khan, which was 18 years, one of the best places I would say I worked with in terms of brokerage houses, because of the culture that they had. Don't mind if I'm talking continuously, I'm going to cough. It's just an allergy from talking too much. But but I'm ranting, so it's not like I'm talking slowly. So my sense is that most people fail at execution, not just, but they actually require to be spoon-fed, and that's something I didn't want to do. I want people to really wake up, stand up, and want to learn. Of course, it's very easy to learn from my work because I'm sharing all the models and the methodology that we're using to make an entry exit. And then, of course, for people who want to really get hands-on or maybe feel the need, apart from reading our work or reading the books, which I've listed out freely in the Educate Yourself section. If you see it, the entire list of books that I think complete the entire learning process is there. But still, if you need, then of course we have a mentorship program to help people learn it hands-on and specifically ask questions. So that's what we've ended up doing in terms of an organization to take it forward. Hope that people, instead of wanting to be told when to enter, exit, exactly how to position size, which is very difficult because it varies from person to person, but the methodology is constant, how you should do it, what you should do. And it has to also be done in real time. So if you think that, I could actually communicate with a large enough audience in real time, it's actually not possible as much as we may think it is. And I've seen that in my work time, like I said, over these years, either the communication can get lagged because they didn't reach the said person in time, his phone was not available. There's also the other problem that you may not believe what I'm saying. Everything that I'm going to say about the market today, there could be a good 50% of people who say, no, this is all wrong. And so if I achieve a certain outcome at the end of a period, I say that, I've made money over the last 6 months. They'll say, garbage, you couldn't have made money because your views are all right or wrong, or I couldn't have executed it. And next, worst of all, you didn't believe in what I was saying. So in any case, If I told you what to do and you said, no, this I don't think will be right, so I'll not do it, you probably missed the best trades that I, as an analyst, had to put out. So a lot of analysts can get very, very dissatisfied by the idea that people do not follow their cues, because at the end of the day, nobody's going to get the market 100% right. This is a probability game. You can only be right 60 to 70% of the time if you're very good. Okay, 70 is like the very good level, 60 is like the good level, and below 60 is the average level. Of course, you don't want to be below 50. But I'll tell you this much, even if you have a strike rate below 50 and your risk reward ratio is very, very high, trades can get skewed. For example, and I did this math yesterday, I didn't think I would be sharing this information. In the month of June, I had one of my best months in terms of trade, simply because of size. But then I went and did the numbers. It was not size. I had only around 9 out of 24 trades that went right in one of my best months in terms of value. That's 37% strike rate. So I said, then how did I make money? It's because the risk reward ratio would have been 9 times or more. Okay. Which means that some trades pay off far, far more than others. And the losing trades have a very, very low value, which means your average loss per losing trade should be very small. And average win per winning trade is very, very large. So there are 2-3 ways in which you can, either you have a high strike rate, you would be right 60-70% of the time, but you should have a 1:2 risk reward, which means your winning trades make 2 times the losing trades. Then also you will do fairly well. Okay, so it's a combination of 2 things. How many trades went right, and what was the average win per winning trade? What was the average loss per losing trade? And if you measure that, it sort of tells you whether your portfolio is making money. So there are some day traders who run it like they have trades only who 10% of the trades make money, and they make money every day. But that's like 1% in a million. So day trading is something I don't do. It's not my cup of tea. But that's why I said 1 in a million of the people who end up making money in day trading, because it's a very specialized skill of scalping the market. It's not even about the analysis. It's really about reading the screen, scalping the moves, and being able to do it, and having the ability to take that stress of watching the screen all the time, and walking away from it when something goes right or goes wrong. So very, very different. If you can't handle that time frame, don't. For me, the real money is made in peace, which means analyzing the trend, knowing that the market will go in a particular direction. So if I think the market's going to go up 5 to 10% or down 5 to 10%, then I start bet sizing on that direction. And so then learning to bet size becomes an important skill set for everybody. I can say Nifty will fall. It doesn't fall for 5 days. People think loss ho raha hai. Whereas were you able to hold on, and were you able to bet size, so that if it goes wrong, you lose less, and if it goes right, you make more. And that, I think, is the important learning, and you have to build it in. You have to learn to do it. It's a process. You have to force yourself to do it, which means sort of getting over the greed of wanting to have the entire position all at once, and also the ability to hold on, to believe in your view. Now, if I tell you something is true, you're not going to believe in that view. Okay. But if you know why I told it to you, why it looks like that, with all the reasons, and if you're able to look at it in the same way yourself, which means you have knowledge of the science, of charts, of macro, of fundamentals, and then you're able to place those things in one place and understand, yes, this is what is happening, then you'll believe it in it more. And which is why I say that for me, it's more important that people get educated and understand the conversation I'm trying to have and why I'm trying to say something, rather than simply, go by it, because most people will fail at execution because they have their own behavioral finance problems, as we call it in the scientific language, which is basically mental blocks that come from various things that we learn from childhood that have to be overcome before you can successfully execute. So I think that is the sum total of my thoughts on this. And so based on this, where have we really gone with the market over the last, a year? So I'm just going to, I'm just starting off Metastock. But over the last year, essentially what has happened is we've had varied views, on the market. In fact, when we started to recover from the pandemic, the initial view was that at least let's start with expecting a 50 to 60% retracement of that fall. We'd had one of the worst bear markets, specifically in mid and small cap stocks. So this is sort of the big picture wave count that I've been considering on the Nifty for quite a while, with a couple of variations that you can actually see on this chart, which I'll try and get to. So as we went out, so there are also variations with the Sensex. This low did not break on the Nifty, but on the Sensex, this low stands broken. Okay, so can I really mark this 1 and 2? So very, very long term, when I do a 100-year analysis, I take this as 3 and 4. And once I do that, then I have to actually change the way I look at this whole, entire move, which means I actually think of whether this can be 1, 2, 3, 4, and can we really complete 5. So that was sort of the arguments that we were working with when we came to this place, because as you'll remember, the period post 2018, which actually starts somewhere here, okay, this entire period, this 2-year period, 2018 to 2020, doesn't appear like a very severe market in the Nifty, but in the broad market in terms of stocks, it was pretty bad. You had the entire unwind of the NPA problem, the PSU banks, all these sectors which are highly leveraged going down and under. The mid and small cap indices were through a 2-year bear market, which was pretty steep. So if I actually look at the chart of the mid cap index, this period which I've marked as 3 and 4 over here, okay, was one really steep bear market. So at the end of the steep bear market, and we had been through almost 2 years here, I was starting to judge, I think as early as here, that, is the worst over? Have we bottomed out? And then you had the tax breaks from Finance Minister Sitaraman coming out, which sort of helped that rally as well. And then the pandemic failed it all. So post the pandemic, the first thought was that, are we doing a retracement? So this is how I actually started out. So let me actually go to the Nifty only, and then we'll come back to this. Okay. So my first thought was, why not look for a retracement of this, and which itself meant if I do 61%, and frankly telling you at 8,000-9,000 index, 61% also most people thought was crazy. That's a chart of the Sensex. So I think most people have become comfortable with Nifty numbers, and so therefore I just switched out and coming to Nifty. So 61% at that time meant going back from, say, an 8,000 Nifty to 10,500. So my initial target, I think, for Nifty in April was 10,500. Now, once you develop this initial impulse, and then I saw that the dollar was doing what I was thinking, at least since 2017, which is stay in a bearish trend. My sense was that this could get bigger if the reflation trade plays out, which means the dollar goes down, commodity prices go up, which had ended a major turn down, specifically because oil went negative, and events like that are usually major turning points. You don't get such kind of capitulation events at the end of a normal routine correction. It's usually the end of something big. And that means the start of something big. And so once I thought of that, I think that's when in May, I wrote about the reflation trade, and actually changed my view from a 61% retracement to a possibility that you can retest the highs, and who knows, you can even get a fifth wave. Okay. And that's when I actually published a very different chart. Okay. And that different chart, I'm going to just open it here. And that different chart is this. Okay. So this is, sorry, this one. Okay. So this is what we ended up publishing. Okay. And in that time, so you can see this is a dated chart. It's there on the website, and it's actually a few months after the pandemic, where after May, once it started to recover, I said, what if this is the case? What if we're only doing a fifth wave? It's only much later that I started to consider, because of the sheer strength of sectors that participated in this move, that can it be something other than fifth wave? So today I'm trying to keep both the options open, because frankly, the truth is I don't know. Okay. And I like to be in that I don't know camp, because it keeps you open. So let's keep two potential options open. The first one is, of course, the original thought. And the beauty is original thought sometimes end up being right. And as much as I would hope not, because if I mark this entire move post 2001 as a 5-wave advance, then it would mean that a 20-year bull market sort of ended over here. And if a 20-year bull market has ended, are we going to retest the fourth wave of the lower degree, which means actually doing exactly what we did in 2001, which is the Sensex actually went back to this previous low and broke it slightly. Okay, the Nifty did not, but the Sensex did. That simply because IT stocks, which are the bubble group of that time, were not part of these indices, and therefore it led to that breaking. So it doesn't have to happen, because like I said, Nifty didn't break. And so even this time around, because a lot of sectors have started new bull markets breaking out of 7-8 year ranges very similar to what they did in the 1990s. I would like to think that this is still wave 1 and 2 of something, but I'm just showing you an option because the world is in serious trouble. It's actually less about us than the world. But what I also want to highlight, irrespective of whether we come down this much or not, is that we did have an objective of 18,800 over here. at this point of time. And along the way, as we went up, I just kept raising the bar. So at 10,000, I thought 12, at 12, I thought 15, at 15, I thought 16, at 16, I thought 18. And surely the critics will come out and say, sir, at 18, you said 20. I don't deny it, but it cannot be looked at, without knowing what we've said all along the way. Because naturally, as you keep going up, you keep raising the bar. And at some point of time, you need to change your view, which was the big fight. I think in every weekend with Indiacharts session, I and Chavan were having the debate, do we reverse trend? My fear, though, and including some of my, one of my friends who I should not name, kept calling me and telling me, the market can fall to 15,000 or some 15,500 was his number. I just told him one thing in January. I said that if it actually happens, okay, if it does happen that we fall that far, then I might actually change my entire view of being bullish from a 5-year perspective. And what I mean by that is more on an immediate basis. It doesn't see eventually every market is going to every bear market followed by a bull market. So that's not what I mean. What I meant is that initially I was thinking, okay, I changed my view from this being 5 to this being 1. Okay, but my point was that if this becomes a deeper correction, okay, then it cannot just stop over here. Okay, so if it has to be a consolidation and go higher, if the strength of the world is that high and we are inflating everything and inflation doesn't go out of control, then MMT is actually working. MMT is the whole option that the world took, specifically the US, that they will inflate that debt by creating some level of inflation and getting monetary stimulus, not just from the central banks, but also government participation. And the pandemic actually allowed the world to do that, where governments and central banks simultaneously provided stimulus. And so that actually led to this high level of inflation. But the thought was inflation goes up to 3-4% and we can persist it there. If we can, then markets simply go on riding, because markets are a reflection of inflation and inflation is good for markets unless it goes out of control. So that was the idea. If we had been able to not get into this trouble with inflation, then all we would have done is a small correction and gone on higher. But if somebody argued with me in January and said, no, you'll break 15,500 or you'll reach there or you'll go to 15,000, then I would say, then it's not a normal correction. It's becoming a deeper correction. And if it's a deeper correction, nothing will stop it from going to 61%, which is 11,750. Okay. So the fight was, are you going to stop above 16,000 and the bull market continues with a short correction? Or are you going all the way back to 11,750 in what can be even a second wave inside a larger bull market? And why a second wave? Because all the sectors that consolidated over a year, very similar to what happened in the 1990s. In the 1990s, it was everything from Reliance, ACC, which is cement, capital goods, power, oil and gas. All of them consolidated. They didn't make new highs. The only sectors that did well was FMCG and IT. Now, that's very similar to what happened in the last 10 years, right? Now, 2009 to 2020, you had IT do well, FMCG do well, the whole consumption theme, which is defensive. And other sectors which didn't do well only broke out post-pandemic in this rally. And therefore, they would be in their first waves of a new bull market. And any correction would be a second wave. The question was, will you get a deep second wave or not? And I think that question has been answered because inflation running out of control has forced central banks to tighten more than they wanted to. And that simply means now we're going into a deeper second wave. And so this is the first line of acceptance that something has changed. And now because you're going into a deeper second wave, I'm beginning to ask whether this original view, which I wrote back then, is this also right? And I actually don't know the answer. So I'll start with the idea that you can at least go back to 11,800, okay, or 750, which is 61%. Surely there's a large cluster around 14,200, 14,500, where all of us would like that the worst gets over. But I'm saying what is happening around the world doesn't give me a sense of that happening very surely. So we can surely take that judgment call once we get there. Every time the market falls a bit, we are trying to take that judgment call. We feel, oh shit, it's fallen a lot. Is it bottomed out? Frankly, even I ask that question every time. As much as I remain back of the mind, once I've turned bearish, I should think that, it'll play out in full scope. But we do go back on it, look at it, check on it, doubt ourselves. But unless we find the answer that, yes, the worst is done, capitulation has happened, things have moved from overvalued to undervalued, not in between, not fair value, okay, overvalued to undervalued. That is how bull and bear market should work. If they're going into a deeper bear market, then we aren't there yet. And so that, and one more thing, rotation, which we are all starting to see, right? Every sector is rotating. One sector makes a new high, other one makes a new low. This rotation must go on till even the bottoming phase where different sectors bottom out. We have just ended the phase where sectors are topping out. Okay, we haven't even reached the point where they start bottoming out. So the topping out rotation has just ended in April. In fact, for some, maybe even just now. And we still haven't seen the major break point. Okay, so this is one thing that I wanted to highlight, the alternate wave counts and why I'm thinking about that way. I can always go to this. This is the long-term chart of Nifty. I can go to this and I can think that, okay, the index did do wave 1 and 2 back here, 3 and 4. And so did this end? So this is what I started to consider once the rally became very, very big. I said, okay, is it that the panic in the pandemic, writing off of the NPAs and all that, very similar to what happened after the GFC for the US, means that the worst is over from an economic standpoint and things are beginning to improve. So why shouldn't we simply take this as wave 1 and 2? So the first thought is, okay, wave 2, but now we are thinking about deeper wave 2. But why shouldn't we think that this is a new bull market versus that the 5th is over, and that means, it can actually retest this previous low, which is really scary. The only thing which comes close to that, like I said, is 2001. It happened in any case. It happened despite a recovery in core sectors because of the bear market in the US. Again, that was Y2K. And so there's so many similarities when you actually draw back and see what is happening right now. Not only here, but also in macro, there are a lot of similarities with what happened in 2000 with what is happening right now. Okay. I always try to draw similarities, when we thought that, okay, maybe the worst is over, we are trying to draw similarities with 1940s. Okay, if the worst is over, and US is trying to print its way out of money, out of this thing with inflation. The last time they kept interest rates at negative real interest rates was for an 8-9 period was after the Second World War. And they managed to, reduce the debt to GDP ratio. So can you actually do that? So that was the first thought. So if you can do that, then you get multi-year bull market. But now if inflation, has failed or overshot and they've not been able to manage it, the risk is that you're back in the old camp. And so that's why we are switching back from comparing to 1940s to comparing to some other period. And that other period to me comes back to more like the Y2K period, because you had a tech bubble, but simultaneously with a tech bubble, you also had what I was calling, in 2017-18, those who read the report, I used to call it the second wave of the dollar. And there's a particular reason I used to say, I had said that I plotted a chart and then I stopped publishing it. And it was based on this. See, the last dollar bull market started somewhere here in the mid 1990s. Okay, and as this started, that's also the time when US was in recession. Okay, 1992, 94 was US was in recession and started to come out of recession. So which is somewhere around here. And then this is what brought them out of the recession, because that is where Alan Greenspan jumped in and started to cut rates. But once he did that, the dollar trend changed. Now, why did that happen? Of course, the dollar has its own mood and its own cycles, and it changed. Now that change may have been good for the US, but it was not necessarily good for many other countries. So you had the Southeast Asian crisis, you had the Russian breakup of the Russian Union. All of that happened during this rising dollar phase. So this rising dollar phase, when I studied it closely, it had two segments. The first segment, then it had this long pause in between, and then it had the second breakout. The first segment is where it caused some crisis like the Southeast Asian crisis, etc. And then they bailed out a lot of them. IMF came and gave them money and things were sort of back to normal. Then you had the second breakout in the dollar. The second breakout of the dollars was during the tech bubble going on. It was going on. And then it got overheated and the central bank in the US thought, well, we need to stop this. And they started to raise rates in 98 to 2000. And eventually they broke the Y2K bubble. Okay, and once they broke the Y2K bubble, we know what followed. Okay, so this sort of happens around here, this point. Maybe I should mark it in red. Okay, so this point, this is sort of where it happened. After the dollar broke out, it popped the entire bubble. So I was thinking something like that was happening maybe over here. Okay, and then when the dollar reached here, the daily sentiment index was almost 93%, which means everybody was bullish. And it looked like the dollar stopped out. So here I took a call that the gold has bottomed, dollars bottomed, commodities will rally. And so the first time I wrote about reflation was actually in 2017. And then 2020, when we revisited this, which I didn't expect, I thought 61% is enough, we'll go down. But the pandemic caused this spike. But we didn't cross this previous high. So I became even more confident of the reflation trade. And that's where I wrote Reflation Trade 2.0, which is what we've seen through 2020. So now, note this is a dated chart. The dollar index is already broken out of this entire range. So I'm going to just clear all the writings. And where are we on the DXY now? We are somewhere here. And now when I look back at this chart, I wonder, it may be a little bigger in perspective, but this is sort of, are we doing this again? Okay. We've had a tech bubble, which is now I'll call an everything tech bubble, because everything related to tech, from cryptocurrencies to NFTs to whatever it is, all these new age technology companies which got overvalued, everything has happened in the tech space. And that tech bubble busted when the dollar broke out to a new high. And are we doing something similar? Because we've broken out to a high. So it doesn't stop here. My main point is, some people think, you're breaking out of an 8-year range. How can you expect it'll stop here and go back? It doesn't work like that. When something big has happened, this is going to go way higher before it stops. And so you'll really have to wait. And of course, we know the narrative now. Right now, it is fighting inflation. And so it's fighting inflation unless you get that data down, not just in terms of inflation, but US housing. And then it is the wage market, which is the US labor market, cooling off from no jobs. Jobs are available and people are not available. That's the real situation on the ground over there. So unless that situation changes, so that's again the same overeating of the market. So and what happens, when you try to tighten into what looks like overheated, you end up slowing it down. And once the wheel turns the other way, then turning it back is not easy. So there was a study when they started talking about MMT, and when the Fed was trying to, do quantitative tightening for the first time in 2016-17, what everybody was saying is the reason they are doing it then is that if and when the next recession comes, they need to have room to cut rates, because it takes at least 5 to 6 rate cuts before even the economy starts to respond. And this was based on the experience they had in the 1980s, last bear market, next one in Y2K 2000, 2008. All of these, they had to cut rates multiple times before the market change trend. And this time we are thinking that, just because 2018 he backed off from quantitative tightening and overnight markets reversed, that wo ek hi baar mein ho jayega. But when they are tightening this inflation and they weaken the market so much, I don't think the first rate cut will turn the market. If history repeats, for example, we say, this time is different, is wrong. This time is never different. It's always history repeats. Then history shows that, it'll take several cuts. So first you'll raise rates, whether to 4%, 5%, 6%, I don't know. And once inflation starts coming off, they're going to have to cut rates all the way from 6 to 3 to 2 to 1 before the economy responds. And that's the challenge, and that's the whole timing aspect of this. So in that timing aspect, the very important cycle that plays a role in our understanding, how this is going to work, is Martin Pring's, cycle analysis. And if I have that chart here, if not, it may be in the. It's a very simple model. Okay, it's just that the bond market is always the first to move. Okay, so let's just color that. Let's say bond market is in red. And it's always the first to move, which means the bond market is the first to top out, the first to bottom out, and the first to top out in every cycle. Okay, that's sort of what we saw in the previous cycles, right? Interest rates are raised, market still keeps going up. Okay, and the market keeps going up to the point where finally equities can't take it anymore and they roll over because interest rates are rising. And the same on the way down, rates keep being cut. And then after that, the equity market bottoms out and so on. So there's a lagged effect. Okay, and then there's a third one. And the third one, which is the most interesting one for some people, is commodities. So commodities is the last one. After equities peak, money moves into commodities as an inflation hedge, and then eventually commodities roll over and go into a bear market. Now, ideally, theoretically, commodities are the last to bottom out, but because of the way liquidity is moving in panics and busts, I've actually noticed, and you can check it, both 2008, 2020, commodities tend to bottom along with equity. They all go into a massive panic together. But from a modeling perspective, let us just keep it like this. Okay, so even if you go to 2008, you'll notice, interest rates were starting to be raised 2006. US stock market topped out 2007. And this is in terms of bond market. Okay, so the bond market topped out over here and rates started to rise, irrespective whether the Fed did it or not. And then last, commodity prices kept rising till June of 2008, almost 6-8 months later. In June is where oil hit $140 or $45 and then topped out. I think 152 on the NYMEX, and then it rolled over and went down. And then in October, both oil and equity, both of them bottomed out together. So that's a very important thing to really see. And then what happens, you start cutting rates. When you start cutting rates, bond market starts going up. So from here, rate cuts are done. Stock market is still falling. Eventually, rate cuts affect the stock market. It starts rising along with commodities. And so this is how the whole cycle. So where are we today? We are still at the point where the bond market is falling because interest rates are still being raised. So we are not even close to equities bottoming out. The first sign will be whether the bond market starts to rise when the Fed backs off from interest rate hikes and maybe the bond market reverses trend. That will be your first sign that we can actually be getting to the point where equities can bottom. Okay, and only that after that will we look for, okay, are equities bottoming out and commodities bottoming out. So the bond market's got to bottom first, and once it does, you'll actually start seeing an inverse correlation between equities and bonds, where falling equities will be associated with a rising bond market, which is essentially what we also coin as the risk of trade. Money is leaving for safe haven into the bond market. So that will happen in the worst phase of the bear market, when equities just collapse, is when your bond market rallies because money runs into safety. Right now, because of the inflation environment, money is running out of both equities and bonds. And so that's the in-between phase, somewhere in between here. This is where we are right now. Okay, so we really got to wait for that, for it to happen. So we are still early in terms of being able to call a bottom in the market. Okay, and surely it's possible that the dollar also tops out ahead of all of that, but I think the bond market should be the first signal, because once the bond market tops out, the dollar will also start reversing course, very similar to what you saw here. The dollar started to form an ending diagonal over here, okay, as the interest rates were being cut to sort of stimulate the economy again. So that's the signal I'll be looking for as a sign that the worst is over, irrespective of what the Nifty is. Nifty is 14,000 and this is happening, I'll turn at 14. So what I've tried to say in the long short report this time is, don't keep a level in mind. Let's not get programmed by this particular level or that particular level. Let's look for these events to play out. Definitely, I mean, everybody is on the economic and fundamental side, coming out and saying that India is in a better position. What I'm reminding them of, yes, that was also true in 2009, in the year 2000. Between 1994 and 1998, a lot of consolidation had happened in the Indian market. Okay, and you can actually see that on the chart of the Sensex, which I opened earlier, this one, where you have history. So in this historical chart, a lot of consolidation happened here. Okay, and that's similar to all this consolidation happened here, only that in this case it's upward slanting, because the sector management was a little better. We handled this much better than the last time, I think, because the last time we didn't allow IT sector to be in the indices. So the indices just reflected what was happening in the core sectors that were consolidating, like power, cement, capital goods, etc. But here, because all these sectors, they kept changing the components of the index throughout this phase, every month, every 2 months. And so whatever was bullish was in the index. And so it actually helped the index move up more. But if you look at what happened in the economy underlying, it's very, very similar during both these phases. And then you got this run up, which was the final bubble for the tech sector, but the start of a new bull phase for the other sectors. And maybe we had something like that. You're seeing a pickup in capital goods, real estate, all these stocks picked up in the last 2 years, which is just the early beginnings. But at the same time, we are getting a bubble pop in tech and everything beyond that. And the US specifically, because this was an unwind in the US because of the rising dollar. And here also we are seeing an unwind. And once that overheating unwind is complete, I think we will be set for a much longer bull market. So this is a very simple, repetitive pattern I'm looking for, with only one difference, that I don't know whether this is wave 2 and only stops here, or whether this is something bigger because it's been a long bull run and it can get deeper. So I'm saying, forget whether it's bigger or deeper. Let's not make that call. Let's make a call on how the bottoming process takes place, from the bond market to the dollar to whatever. And once that is done, then we'll take that call. Now, of course, you'll have to come to the specific of Elliott wave, being able to tell you also when is the bottom going to occur. Okay. And all the bear markets that I've seen, usually wave Y is the most largest leg. Now, because of rotation, we've seen the main sectors in India actually top out here. So I'm more and more inclined to mark this as the end of the 5-wave rise that we saw from the bottom in March 2020. So from the pandemic, this is sort of how I finally thought I am going to market. Okay. That is take the fifth ending in January, because we have divergences between sectors. In January is where your IT sector and small cap index topped out. They made their all-time highs over here. And so I find that is a better place. Even then, all the way into April of this year, we still saw new highs in power, oil and gas, metals. Why? Because the reflation trade, the inflating sectors, which was the whole part where the bull market started, was still rising till here, and which is probably why every time I look back at the market, I kept finding that there are still every sector is not falling. And so I remained bullish throughout this phase with some criticism. Okay. But from a pure, both an investment and portfolio perspective, it was okay for me. I know some people have been hurt more because maybe they have more small caps, or they did not churn out of what was weakening during the period. And maybe I was like I say, holding more onto those sectors which were in the reflation trade, which is like metals, things like Vedanta, which still made a new 52-week high over here. So finally, it's only after that happened and prices started to fall. Moment it fell below this level where it looked like, no, this rise cannot be impulsive anymore. And then it broke the 20-week average, is where I wrote for the first time that I have gone 65% cash. A few weeks later, I've raised that to 80% because I've also moved out of US gold and silver mining companies. Given the rise of the dollar, I just wanted to back out. So it's a major risk off as far as I am concerned. I've just thought that why take a call on anything? Let this all play out, and then we can always get back in, or let there be a clear buy signal again, rather than holding on to something, hoping that it will work out eventually. That's not how I work. Hope is not a strategy. So this is sort of where I go 65, then by sometime in May, go to 85. Okay. So 85 or 80, I can say. Okay. Let's say 80. So that's my position. Okay. From here on, it's 80%. And few things holding only which may have done well in the past, and because you feel chalo theek hai, let's see, because you can also trade, you can always have hedges and some shorts, so sort of your net position becomes 100% cash only. The point is, where do you turn? So, and was this period really bad? Now, if you are simply trying to be long at every level, the answer is yes. If you know how to position size, you would sort of not have it would be painful, but it shouldn't have been bad. So does it mean that I wouldn't have lost if it went down here? Maybe, but if it rallied right back from here to here, because I'm still playing long, I would always make it back. And again here, because I would still be bullish. So I was bullish at this bottom, I was bullish at this bottom. I was just not bearish for this correction and this correction enough. Okay. But now, from here on, I've been bearish, and I'm still very, very bearish for much lower levels. Whatever that level is, I'm not changing it. So this is my process. For whatever reason, it has worked for me. Okay. Even though pain in between. Would I have wished to have turned year or year? Of course. But wishes don't grow on trees. It has to be your methodology, analysis, your logic, your mind has to work. And God pray it works early enough, not after it has fallen or crashed, that you realize that, oh, this is what happened. So, so I think if I say at this level, in this range up here, historically, if it goes all the way down, if I'm right and it goes all the way down, this would have been a very good exit level. So that is how I look at it. The reasons and logic were there. And there are still enough reasons. For example, now we look at the cycles. Okay, we're going to go cycle by cycle. So what are cycles? Cycles are basically a look at the Rohit momentum indicator, now available on Sharekhan Trade Tiger for everyone to use. On TradingView, of course, we only give it to people who've completed the mentorship level 3. And what it really tells us is basically a rate of change. Okay, we are trying to measure a smooth rate of change. So it's nothing more than that. But if you think of it as a smooth rate of change, what you would really think of it as cycles that move above and below the zero line. And this happens in every time frame. Okay, so this is your zero line here. And what you're trying to pick in this is an every time frame. So not just short term, you're also trying to see what happens in the long term. So short term, of course, every buy and sell signal, we can keep trading. Okay, it'll be bullish, it'll be bearish, it'll be bullish. But why don't turn bearish on every sell signal? Because there is recency bias, right? Recency bias means what? That what happened most recently, which is during the bull market. Okay, and this was one of the most unusual bull runs where the index has doubled or more over a 2-year period without any deep correction. Okay, and that meant that every time there was a sell signal in the indicator, market didn't fall much. So it was really not worth it. And how I think about it is, if my larger view is bullish, in the short term, I always do long exit, long exit, long exit, which means I would go long on every buy signal. I would not trade the shorts during a rally, during a bull run. And the idea that the retracements are short are not a reason for the market to fall more, but a reason of underlying strength. So when you get very short retracements like this, and then the market keeps going up, it simply, from here itself, it simply means this is a very, very strong market that doesn't want to pull back or even retrace 60-80% before going higher. It just wants to keep going. And so small retracements inside a bull run itself are signature of a bigger bull run. And the same is may also be true on the reverse, which I don't know, because I'm seeing, while I've seen small retracements in a bull run, I have not seen small retracements in a bear run. All the bear markets that I've seen, 2008, 2012, 2020, they've always been big retracements. So if I actually go back here, okay, and I look at this bear market, see, I'm keeping all the indicators on the chart. I hope that doesn't confuse. Okay, I'll bring this chart back up with the indicators once I get into that analysis. Let me just put the retracement tool. Okay, so what you see here is each of these bounces were doing a good 50 to 60% retracement. You see this is a 60% retracement of the last fall. So falls from here to here, retraces 60%. Nice. Now that is what the past has trained me to do. But suddenly, when we are seeing this most recent fall, see, even here you did get a 60% retracement in this small bounce. But this bigger sell-off, which has started from April, this bounce, no retracement. This bounce, just over 38, not even 50. Okay. So I'm actually beginning to think these small retracements here, are they also similarly in reverse a signature of a much weaker market? Okay. So we start expecting like the past, big retracement aayega, pure fall ka retracement aayega. Wo idhar aa hi nahi raha hai. And the reason it may not be coming is again the same stupidity of rotation. So because rotation has been the topping process here, which means some sectors like banking, then you have IT and small caps, mid caps, and then you have everything else, metals, oil and gas, and all the reflation trades. Now everything is topped out. And now everything is starting to fall with different wave counts on each sector chart. And so when something is rising, something is falling, something is in wave B, something is in C, C1, C2. Because of that continuous selling, this is going to become something like this, it just keeps going. And that's sort of what is happening in the US tech market as well. It is in wave C, and wave C is just unwinding in C1, C2, C3, C1, multiple subdivisions of the C wave. And if that is what is happening, then we are also in what should be wave Y of a larger degree. Now I'll come back to that wave count, which I was talking on the previous chart. I'll get through the cycle so that I can close this momentum cycle chart. So we go then to the weekly momentum cycle. Okay, so when we go to the weekly is in sell. This is the second cycle in sell from here. Okay, so we had one here. It came back, looked bullish, managed one more rally. Again, we got a sell signal. Now here I was ignorant because I thought that no, stocks are doing well, but this remained in sell all the way till here and gave a buy signal again. This was the last buy signal. After that, when it gave a sell signal, this is where we've given up after a triple top. We've sort of given up over here and started to decline. And now that we've started to decline and we are in sell mode, I think this is now going for that exponential move on the way down. Okay. And this is the thought. So we've also made, in terms of Dow theory, the first lower low, lower high inside this particular downtrend. Okay. So we've actually broken this. In the very near term, as I've written in the weekly report, this fall, if this is A, this was 5 weeks long. Okay. We've done a B wave. The C wave could also be 5 weeks. So we only done 2 weeks. We at least have another 3 weeks down to go within this structure. Okay, so that's the first thing. So that means this momentum indicator, which is still in sell mode, is actually exponential to the downside. It's not yet crossed back. And now with making a lower low, lower high, the indicator will simply extend to the downside. So it will do something similar to what it does in previous bear markets. So if I actually put a line, the previous bear markets, the negative momentum can often come all the way down here. So we look for something like that to happen. It also happens in the worst leg of the bear market. And when we say worst leg, okay, that means the largest leg. Now again, I'll come back to that in the wave counts. Let's go to the next line of momentum, which is the monthly. Now on the monthly momentum, and here I actually want to bring back the previous chart, which is with the cycles. And I want to actually bring it on Nifty so that we can actually. Okay, fine. We'll look at the Nifty levels later on. Let us first understand the structure. So in the monthly, what is happening, and another reason for me to think that, bull market is on or not, was actually that the last bull market. So some of you have asked, should we compare this with 2004? The correction just happened till here and then it went on. What happened though throughout this bull market, you can see it here. This red line is the 20-month average. The 20-month average did not break. 2006, here the market fell 30% in 1 month. Did not break. Okay, the point is that entire bull market occurred on top of the 20-month average. It did not break. And here it did break when this Y2K bubble busted. So the point was that if I was going to get a short retracement and rally higher, I will not break the 20-month average. So in March, when I was still bullish, we didn't break the 20-month average. We rallied right from above that. We came close. This is the red line. And then we bounced back. But right now in April, we've touched it. And now in June, we are actually trading below it. And end of the month, if we close below the 20-month average, I would think that something is broken at the monthly level. Okay. And so that would be a big change. And that also means that we are going back to the 14,000 cluster, which is the bottom end here. The lower band, 40-month average, this previous swing low in April here, that's also around 14,100. So that entire cluster between 14,100 to 14,500 is where we are headed, is the thought based on the monthly setup. Of course, we haven't closed for the month yet. We still have 2 weeks left before we get the monthly closing. But we are trading below it, which is itself an early warning. And end of the month, you can see if we are still below it, we are likely to head much lower. But of course, the weekly structure shows that we are heading much lower right away. So that is where by the time the month ends, who knows, we would have already reached one level of target. The other thing which will happen is, remember, June is also a quarterly closing. Okay. And on the quarterly chart also, we are at the risk of going into sell mode. Now, there was a sell signal on the quarterly chart here in 2014 and also here in 2020. This was a sharp sell-off 1 month. This was 4 quarters of a downtrend. Okay, this actually was a multi-quarter downtrend in some of the mid-cap, but not in Nifty. And so because it wasn't in Nifty, again, it goes back to the idea, was this entire cycle, okay, the only time? So now here again, I'm using a Sensex chart because you cannot see the past cycles in the Nifty because you don't have data prior to 1994 when the Nifty was created. But in terms of the Sensex, what you can see is that there was this entire cycle which went back to the zero line back here, post Y2K, and slightly before it and after that. Okay. And when it did that, we were ready to start a new cycle, which has gone on till today. So till today, we haven't gone back to the zero line. The question is, will it happen this time? Every time I've thought, will it happen? I thought here also in the pandemic, will it happen? Then it touched this 40-quarter average, exactly where it bottomed in 2009. And then I felt there are too many sentiment extremes. There's a capitulation. Maybe it will hold and things will go up. And once they went up, then we changed our view. But because the macro, so that is why I say stock market is always complete science. If I just looked at this, I would have said bear market rally till 10,500. But the dollar and macro study told us something bigger could happen. Now, once again, we are in the same soup. Dollar is rising, markets are falling, quarterly momentum is going into sell. So the question that I raise is, will it only be a sell-off to the 20-quarter average, or will it be worse than that? Okay, will it be a full cycle this time, which will then mean that 5 is over? So that debate will remain till the market does what it has to do. And if 5 is over, then the lower band over here is much lower in terms of Sensex here. So I'll give you actual levels now, and I'll give them to you on Nifty. So on Sensex, I've sort of explained to you the cycle part of it because you have data. Now it'll be easier for me to explain to you the wave structure on the Nifty chart, which is what we'll do. Okay. So this is the Nifty 50 chart. Okay, I'll remove this retracement tool and let me actually then give you the wave structure, and then we'll look at the monthly momentum levels for this. So I have sort of, like I said earlier, decided I want to mark 5, possibly here because of the way more sectors topped out here. And another reason I will finally decide that, yes, this was right to do or not. We are keeping both alternates open in our index module right now on the website, but which is both meaning 5-year or 5-year. But I'll conclude if Y is the largest. Why? Because Y is the third wave. Okay. So when we are saying WIY, what does it mean? A bear market in Elliott wave sense is always ABC. It is 3 waves. Okay. So for sounding very, very technical, because some of you may not be too tuned to it. But what we don't know, and I didn't know when I learned Elliott wave first time in 2000, every ABC I thought bottom ho gaya. Later I learned it can be more complex. Real bear market goes into ABC, X ABC, X ABC at least 3 times. And because it does that at least 3 times, each ABC we mark as WXY to try and count it 3 times, and with Z being the last. So, you reach the end point. So the first ABC is W, then there's an X, Then there's a second ABC. This is where we are. The second ABC is also what we call as the third wave, because it's the third wave, meaning, let me tell you why we say third wave. It means this is the first wave, this is the second wave, and this is the third wave. So it's the third wave because it's the third in the progress of an up-down sequence. Okay, and in terms of wave structure, it is the second ABC. And we wait till a third ABC. But the second ABC, which is the third wave, is often the largest. So even if I go back to 2008, okay, which is the largest part of that leg, it is this. So this is what we call Y. This is where capitulation happens. This is also where equities and commodities fall together. So to just highlight to you, June is where oil prices topped out, somewhere here. Okay. So initially the market was falling because oil prices are going up. Inflation was high. P. Chidambaram came and raised interest rates. In the midst of that, very similar to what Fed is doing, because inflation oil is going up. And then oil rolled over and fell along with the market. Okay, so initially when oil fell, there was actually a small bounce. Maybe it was here. I don't remember the exact date, timing of this. Okay, and then after that, both fell together. So there's that slight mismatch which happens. Maybe it was here. I don't remember. Maybe it was June, July. Okay, so I can actually plot it on TradingView and see, but we'll come back to that. We'll look at those comparisons, but let's just get a sense. So initially, markets bounced because oil started to fall, and then oil and equities fell together in the final leg down. And we are somewhere right now in between that breakup, because if you actually go and look at what is happening in oil, overnight oil fell. So early part of the week, we warned about it in the long short report. Also, I said either oil is going up or it's a double top. Now it's proving to be a double top, which means we've reached the point where oil starts to roll over. So very short term, like a 1 week period, as we are heading into expiration and options, pre-expiry week because of options expiration in stocks next week is where, people whoever have shorted stocks will cover. And so there's always that potential for a bounce. So I'm thinking that bounce, and then because oil is falling, some people might say, oh, inflation will go down, bond yields may cool off, or whatever may happen. And maybe you'll get that bounce on oil. But eventually, if oil keeps crashing because interest rates are going up and the Fed is going to keep raising, you'll get to a point where oil and stocks will fall together. So I think we're coming close to that point. And apart from the fine-tuning short term of bounce or no bounce, you'll get to a point where both are falling together. So already all commodity prices are falling, okay, which was also true back in 08. Gold topped in March. Copper had gone flat after that, was not making new highs along with oil. And oil was the last man standing, which is also the same case right now. So there may be a reason. Today we are blaming it on Russia, but if I simply think of it in terms of pattern, it feels like the same pattern. So for some reason, this pattern repeats. And the last stage of the pattern is always about growth slowing down so much that oil also rolls over and then everything falls together. And then at least you end wave Y. So one of the reasons for me to think that FII top and Jan and wave Y right now makes sense is because we're getting to the point where everything goes down together. Okay, all asset classes. And in that, at some point, bonds will roll over because the fall in wave Y will be so sharp that bond prices will go up because money will go for a safe haven. And second, because oil prices topped out and the inflation risk starts getting reduced. And you go from inflation risk to deflation risk. So now markets are falling not because of inflation, but because of deflation. And that's the inflection point we are at right now. This is also a point where the bubble crab sectors go through their sharpest declines. I remember, and I can actually plot this and show you. So this part at least I've highlighted now where we are on the wave structure. Before I plot and show you that, I was also going to give you levels based on the monthly momentum. See, I've written all of this in the long short report also, but I just want to highlight. So what are we really breaking over here? Okay, so what is the monthly level that's important for this month? 15,942. Okay, we close below 15,942. We are headed to at least 14,200, but I would sense why not even 61% retracement. Now, if I go to a quarterly chart, the 20 quarter average, which is the first support, 12,613. So that would coincide with your 61%. Last two major bear markets went to the 40 quarter as well. So that's at 10,740. So only reason it won't go there is if this is only wave 1 and 2. So let's just put it at that. If this is only 1 and 2, the 20 quarter average and 61% will coincide plus or minus of 12,000. Okay, so that's the normal. If this ends up being a FII of larger nature and things have globally unwind unexpectedly too much, despite our positive macros, because of the global unwind, if it gets deeper, then it's back to the below the 40, then it will probably break the quarter average, just like it did in 2001, and possibly bottom out closer to the lower band, which then actually puts us closer to the previous low, somewhere there, or maybe even if it's above that, maybe 80-90%. So I'll keep a mind open on whatever happens. We'll know that level based on structure. Sometimes it can also be that Z is truncated, because of all this rotation in sectors. I will not rule out that, Y, once Y is over, the bottom is only in. That's what happened in 2008. In 2008, once Y was over, this leg, we didn't make a new low. We simply bounced, and then Z was ABC, a higher bottom, and then it went up. But when this higher bottom occurred, we made a new low in banks. We made a new low in the mid-cap index. Okay. So that's the intermarket divergence, similar to the one we saw at the tops. At tops, we saw so many sectors make new 52-week highs when the index got back to 18,000 each time. Bottom also, we might see something like that. Some sectors will still be making new lows while the market may have stopped making new lows. So a lot of these things which will happen. And at that point, we can make that judgment that, yeah, okay, worst is over. I don't want to preempt it right now. Right now, what is important to know is we are in wave C of Y, which is usually the sharpest and worst leg to be bullish on. You'll be lucky if you get a good bounce over here, okay, which I'm anticipating. And so I say it's lucky if you get a good one. If it's small, you might just get so much. But the bigger picture is the risk is of this happening right now, right away. It's like more immediate. It's not like tomorrow. It's not 6 months later. And then after that, we can waste time bottoming out and sector rotation and value picking. After wave Y, at least some value picking may make sense. Okay. Right now, it doesn't make sense because we don't know what the size of Y is going to be. And now that takes me to the question of size of Y from bubble sectors and stocks. I think unlike 2000, where you knew bubble sectors were Konsa, Ketan ka K10 and KP and I stocks. Okay. So Silver Align and DSQ and whatnot nonsense, none of which are listed anymore. Satyam was not considered nonsense, is still nonsense, not listed anymore. Z was thought as not nonsense, went down 90%, rallied again, got into more trouble this year, and is now sold out to a competitor. So they've gotten themselves into trouble over and over again for whatever reason. So companies that have done that over again. But who will be the ones bad actors of this cycle? It can't be the same ones. Wo to ho gaya. That is history. Who are the bad actors? So this time, because you don't know, don't hear names of who's operating the market, and you don't know which are the mad ones, except where the biggest PE ratios are. Which are the ones that all the private equity chased and sold to everybody. So it's not that you don't know. What you don't know is how bad can it get for them and when. And some of them, if they're still holding up, can they really get bad? And so what I wanted to show you on TradingView, and I'll open that, is how certain sectors did seriously badly compared to others, even while the distribution phase was going on. And I actually want to see it all the way back to Y2K, because it makes sense to actually look all the way back. And this is a stock that has actually been listed for long enough. So you would have seen how I actually went about doing that. So even here, they haven't put out the entire data, but I'll show it to you. Okay. See what happened here. If you see this is sort of, it now historically look like a HNS, right? Head and shoulder stop. This is the head. This is the shoulder, left and right. Majority of the decline that we actually saw in some of these stocks actually occurred after this point. Okay. Now, where was this point? It's really, really important for you to be able to, see it historically. So there's a particular reason for taking NIT as an example. It's among those stocks that had gone crazy during the Y2K bubble, which is still listed. Okay. I can even take Himachal Futuristic if you want, but probably a less tarnished name. But this is what happened. The entire distribution. So here on, till this point, we think it's a normal correction. Nothing is happening to the stock. 90% of the decline from a bubble actually occurred in the second half of the bear market. Till this point of time, you see this high which was made, and there's huge volume at the bottom, as you can see. Till that point of time, it's still a distribution in some of the most hottest stocks of the time. They are down a bit, but there's huge volume, huge volume happening here, which is the distribution still in progress. And it's only after that volume dies, you have this rollover where the biggest decline has actually occurred. The biggest decline has occurred in this phase. So if you're looking at stocks that look like topping out, still not falling, and market is falling, what is basically happening is this. In fact, one of the observations as to the current situation is volumes have actually collapsed. Okay. From the previous period, even the last sell-off in March, you see this, the volume has actually completely gone down into the recent fall. Last 10 days, there was no volume. The entire fall was on no volume. So the market's waiting for some trigger, okay, something to really cause this panic to happen. In fact, this stock has a history of even doing what we just saw, because if you see, there's actually some level of repetition over here, not only here, but also over here. Okay, same pattern. Who knows, it's also happening over here. Okay, and so from here to here, this large decline actually occurred here halfway after in wave Y. Wave C of Y is where most of the damage actually occurred. That is what I'm trying to show here. I only used a single stock example. So then the question becomes, who should you really compare with, in this situation? Because I don't want to get into the naming part. Okay, I only want to show you history. So in terms of history, if I do the same thing again, you notice this is exactly where all the carnage happened in the 2000 bubble. From this point, this is not even a log scale. So I put it on log. And you actually see that because on log scale, you see the percentage decrease. So till here, people are still feeling it's okay. It's just a consolidation. Long-term corrections में ऐसा होता है. Bull market में corrections आता है. Till this happens. And then suddenly it's history. And then it never comes back for the rest of your life. And in every bull market, at the end, you would have heard one story about HFCL have finally done something about itself, that it is going to turn the clock. Okay. And whenever people start telling you that, you should know where things are. I heard that again in the last 6 months. So that's just how it is. Okay. But nothing against I don't want to say anything against anything, but what I want to show is where the bubble is, how that unwinds. So you can decide where the bubble is today and how it will unwind. And if it is not yet unwinding, particular stocks not yet falling, and then now we are reaching the point of, if we are in wave 5 or C, that is where most of the damage will occur, where, these levels tend to break, so what would be those high value sectors? Would it be the chemicals? Would it be something else? If I just plot a chemical stock. Okay. Remember, I said it right at the beginning. We do not give investment advice. So whatever I'm explaining here is for educational reasons, just to understand how this analysis is done. Okay. And where things happen based on the past. So we're not saying anything will happen in any particular stock. We're simply trying to express an analytical methodology. So it's for your education only. Now, if you say, oh, this is the high PE stock that went up so many times, of course, it's been going up for a long time. So it's not even like, only went up in the last 1 year. Okay. But only the very short-term pattern, I'm just looking at this, like if this is a triple topping pattern, it's downward slanting. Okay. Now, usually when you get a triple topping pattern, some people start anticipating what if it breaks and this happens. And if anything like that is to happen, question is, when will it happen? And the idea is the same. It will happen when you go into wave Y. And specifically C of Y is where most of the damage occurs from these patterns that are not breaking down, if at all they have to. You may even want to plot maybe if there is anything to happen. Again, historically, this doesn't look like a bubble stock. If you look at that, it's been since 2009, been gradually moving higher, doesn't give you that feel. But yeah, you can plot anything you want here that gives you that feeling. And main point being, see, the one thing which is different, I think, in this market is that we are not able to spot where that maximum speculation is. But in hindsight, it will all be true. And so one of the ways is to let the market tell you, there's something which is going to take a lot of damage in Y of C. And in Y of C, you'll come to know which that place is. So why hurry? And why should I say I'm smarter than the market? And I know this is the company that is the best in the world. So let the market decide. Let the market tell me that these are the bad actors that needed to be punished. And then I'll take my cue from there, what to avoid and what not to avoid. So that's, I think, a better approach as a market analyst. Believe that you don't know, the market will tell you. So this is where I am on the distribution part of this segment. So we are in a very, very important part of the segment in this market, which is why I think this webinar was important, and we really wanted to share it with everyone to get this idea across that we are not out of the woods. Now, in out of the woods, I have, of course, already explained that the main actor is the NASDAQ, right? The US tech index. And it draws a lot of similarity in the structure with 2000. So I've been making these comparisons with 2000. In terms of wave structure, it has a lot of comparison. And in fact, even with 2008, both of these bear markets, or all three, have one thing in similar, that they had the first wave, which was wave A. They had a nice wave B, which was a good retracement, 60%. And then they had an elongated C, which just went on and on and on till it completed. Same thing happened here, smaller in size, because 2008 was more about housing crisis and not tech. But the structure of the bear market was still ABC, where B was a retracement and C was extended. Okay, so I'm starting to do the same thing in terms of wave marking here. Again, this is very different from EWI, that is marking this as 1 and 2. And the reason I would not do that is that's exactly what they did in 2000. They marked this as 1, 2, 3, 4, 1, 2, 3, 4. This is 1 and 2, 3. Basically, it was going to be end of the world. NASDAQ would have gone to 0 or 100 or something. Neither of that happened. Their views are not wrong in terms of the economic cycle. I think where it is wrong is not the timing of the cycle. It's just that to anticipate that we will not try to inflate. That was their thought in 2002, and that inflating will fail. And they didn't anticipate it will take 20 years of inflation before you deflate an inflationary market. And they're still thinking that fine, if you have inflated it, it will deflate to the same extent and go back to 0. I'll just not start with that perspective, because all of us do believe at some point of time the Fed's going to intervene and try to stop this from happening. Let's take a call as it happens. So I'll just go by history. Take this as A and B. B has retraced 60%, exactly 61% retracement on the NASDAQ and the S&P. And then we've started a bear market, which is 1, 2, and we are now subdividing inside 3. So this is actually 1 of 3. So we are in 1 of 3, we'll get a bounce, it'll be 2 of 3, then there'll be a 3 of 3, 4 of 3, and then 3 will end, then there'll be a 4, and then there'll be a 5, and actual C will end. And this is going to be a long, prolonged phase. It could last for a couple of months, maybe till September or October. Okay. So much for expecting, you'll get a, interim bounce rally, pause in this bear market, but it looks like more like Y2K, where there's no pause. But you know what? Y2K, there were actually many pauses in the Indian index. And again, because IT was not part of it. So IT went down, straight down, but other sectors kept bouncing back, helping the index. This time around, we've managed to keep changing our index to include most of the hot sectors. And so I really don't know whether you'll be able to, do what you did in 2000 in terms of the bounce back rallies. So far, as we noted, retracements have been very, very small. So all I'm going to do is therefore mimic what is happening in the US only till late stages of this move. Somewhere at the late stages of C, we may decouple. Okay, the last time, so somebody asked me this in the mentorship program last time, at what point can India bottom out before the US? Well, in 2001, we bottomed out here, right after 9/11. Okay, so October, when 9/11 happened, this crash happened, and then the US market and India also rallied. And then when US was falling to this low, India was simply consolidating in a range, something like this. Okay, and then from here, and then we took off in a bull market. So we stopped making new lows. Accumulation started at that bottom after 9/11. And the reason US fell more is they were still deciding on entering Iraq. But moment they entered Iraq, which is actually somewhere here or here in this period, late 2002, early 2003, by that time, market had bottomed out. And then it actually kept going up throughout their invasion. And surely they were winning, or they had full control. So there was nothing negative for the market from that standpoint. But till the point that happened, I think US market remained down. And so that was more of a geopolitical angle. But because the Indian market had already completed its bearish phase, helped by the capitulation of banning the then leverage system, Badla, just before the 9/11 event. So basically, there was no leverage only. The system was anyway had no positions. And once you got that last sell-off, it sort of bottomed out. There was no sellers left. So that's also another point of capitulation where, there are no sellers left in the market. And if the same happens this time, something, of course, I don't expect FNO to get banned, but we'll know some kind of capitulation will happen where it's not just, leverage selling, because FNOs are monthly expiry. So leverage anyway is not there in the system even now. So what will cause a capitulation in India will actually be the investment side, where people who've been consistently investing, who've come new to the market, where that part of the market gets scared, maybe exits, mutual fund flows turn from inflows to redemptions, and that would be a sign of capitulation. So we would watch out for those kind of events to actually take a call that capitulation on the investment side has happened, and now probably the worst is over for the market. So that those are other things to really look out for. So already highlighted. So these are the key charts, right? I've spoken just now about the Nasdaq, because it's a bubble, more surely than India. I am anticipating it will go back to the previous bottom like it did here, this blue line. It in fact broke that a little bit. So bubbles usually go back to the previous low and even break it. So we should be open to the idea it will break it before it even starts a recovery. So that means going back to some 7,500 on the Nasdaq composite. Okay, way lower than where we are right now. And that's something to really be prepared to do. Similarly, on the dollar index, we've already specified a much higher level up to maybe 118. The spike will continue for a while. It's not over. Even the very short term, see, you saw a lot of gyrations last week because of the British pound. You saw it because of the mostly pound, because they raised interest rates and said they will raise more. Euro also, Eurozone also, one day it paused because Europe said we will do it next month. They didn't do anything now, but they're at least trying to push the market to start believing they will. And so that tries to put a brake on the rising dollar. But immediately you saw yesterday on Friday, the dollar's up again. So the reason the dollar's up now is not just because of interest rate differentials, but it's also because the whole risk of trade is getting deeper. And that means that US, which is the major investor in all global equities, is pulling out. Every day there are redemptions. They're pulling out of US market. They're pulling out of Indian market, emerging markets, everywhere. And the money goes and finds its way back into the US, okay, or back into those funds. And so as it's finding its way out of various countries, those countries' currencies start to weaken against the dollar. And so the dollar remaining strong has become sort of a pattern, more from an equity perspective as much as it is from the interest rate differential perspective where it started. But countries are trying, they're all trying to raise rates so that their currencies do not devalue too much against the dollar. But what I would say is that if all currencies are devaluing, what's the point of even fighting that too much? You can slow it down, which is what the RBI is trying to do, but somewhere they'll have to let go. And you're sort of at a break point. The Indian currency is at a serious break point where I think, I don't know when, but at some point of time, it's going to really break out hard. I don't know if they'll be able to even handle it when that happens because of the sheer pressure they're putting on it. It's like you're trying to keep a lid. Now, I have seen this at least in other current countries that whenever you try to keep a lid on something, it happened at the franc. The franc kept putting a lid on inflows. One fine day, they had to just let the lid go. And in a single day, the franc moved like some crazy amount, which is like a black swan event typically in currency markets. There were no big failures, but it did cause a major event move. And anybody on the wrong side of that trade gets completely killed. So this is what it looks like to me. Okay, I think the USD INR is sticking up for a strong move higher. Okay, but somehow this trend line is holding out. Even after RBI raised rates in May here, which is where I actually turned super bullish on the USD INR, and within one day later, it started to rally. The first day when they raised rates, it became stronger, and then it started to weaken because the markets lost it. I think this is sort of just waiting to break this. Once it does, beyond this line, you'll start seeing speed in the USD INR. I think somewhere the RBI is going to have to back off on selling dollars, which it is doing so aggressively, because both oil imports are going to need it, apart from the FII outflows that we are having. So net, with such a big demand for dollars, I'm not sure selling your entire reserves is really a solution. So it's a ticking bomb, according to me. The same momentum analysis we did on the Nifty, if I actually end up doing out on the currency par, we have buy signals on multiple time frames. On the daily time frame, on Friday, we did get a negative crossover. So what I'll watch for support is the 20-day average, which is at 77.72. And as long as we don't close below that average, which is sort of held for most of this time period now in the last 2 months, I would remain bullish on the underlying currency. Okay, on the weekly chart, what we can see is the weekly momentum is still bullish. The monthly momentum is also still bullish. And so what I anticipate is that this is possibly a first wave of this structure, and we are possibly starting a third wave of this structure, which can go all the way to around 80, 88 on this if I take the entire size. If I take a limited size, if I say only it's going to be so much, can be around 85. So that's sort of what I'm looking at on the currency pair. So additional observations, and that I'll really want to throw in over here is that in the last 2 days, so yesterday Jay just highlighted this to me, is that the Bloomberg Commodity Index, which we track very, very closely for these moves, is actually given us a 5-wave decline, okay, on the daily chart. So while we've been saying that there's a potential reversal coming for commodities, the Bloomberg Commodity Index was still holding on, mainly because of oil, of course. But with oil recently declined, we can actually now see a 5-wave decline in this, which means any bounce, there will be further selling. So this will end up being wave 1, wave 2. So this is sort of the first Elliott wave confirmation of a trend reversal on the index, because this index was holding up only on oil, right? Everything else is anyway falling. We know aluminium's down, copper's down, everything else is down. So what we have now is even a 5-wave decline in the commodity index itself. And that means this 5-wave will at some point get retraced a bit, but eventually we're going to see further declines within this index. So what we're really looking at, therefore, is a second wave of larger degree. Okay, so we are looking at this ending up being wave 2. The Bloomberg Commodity Index should be in a wave 2 bear market, because this wedging structure should be a bear market that's over from almost a 10-year bear market that ended in 2020. And this is the first rally out of that. And we are probably in a second wave. No, and when would all this be wrong? This would be only wrong if you go into outright deflation. Right now, the hope is that, the Fed is tightening. It will cause things to slow down. So you get a deep correction. But after that, they're going to do the same thing again, which is try to cut rates and stimulate, maybe not as crazily as before. They'll stimulate lesser so that they don't get inflation. But they will try to get things back on track. And that should sort of reverse this into a third wave. Now, this is the hope part. It's only outright deflation that will, take us back to much lower levels, which is very, very hard to guess. I would not hazard that thought right now. I would like to think everything will go through normally. The important part to notice, it's not over. Okay, the correction phase is not over. A second wave in commodities, far deeper, is still on. If nothing else, we go back to the fourth wave of lower degree on this index, and that also would actually end up getting us to somewhere around here. This is the fourth wave. Okay, this is where 3 was, and this is where 4 was. So if this is the fourth wave, then at least this much we should do, and we are still up here because of oil. So still not complete. So similar with oil. So if oil is not doing a bigger fifth up, if it has reversed as we see this week, then we go with the second case, right? The second chart here, which says wave 1 in oil is over. And if wave 1 in oil is over, then our second wave has most probably started this week. And that means going back to this low, which is at around $65 or something like that. Now, if you're going to $60, okay, again, it's not going to happen in a day. It's going to be a prolonged phase, up, down, up. It could be something like this. Okay. Because there are a lot of reasons why there's an oil shortage. Of course, we are slowing demand. If there's excessive speculation, that will unwind first. But eventually it's going to take time. Or else if it does break that for some reason, new production lines come in over a year, then you will do 61% of this entire rise. Okay, we'll take that as it is. But broadly, wave 1, wave 2, eventually you're going to get a third wave. Is it going to be fast? Is it going to be slow with multiple subdivisions? That we'll see. So those are things we get into only later on. But what we want first is a bottom in oil before we get a bottom in the market based on the commodity equity cycle. So it's 11 o'clock. I would like, Chavan, if you need to jump in, kindly do. Otherwise, what happens is I'll just keep ranting. And then we can take on Q&A as well.
Yes, absolutely, Rohit. Fantastic session, Rohit. I must say that you must have scared the whole audience out here. Rohit, you did mention on the Nifty that, okay, 11,000, but 14,200 is the levels you watch out for. So if you can, just get little inside the Nifty and see what is the A equals to C of the Y on the Y wave.
On the Y wave, okay.
Yeah. And also my question to you, Rohit, is you have been comparing this to Y2K bubble. So you mean to say IT will be the worst hit?
Fortunately or unfortunately, it looks likely the case.
Mm-hmm.
As much as, so all exporting sectors were considered defensive.
Mm-hmm.
But exports means US and, world economy. And if the world economy is the one that is in trouble, then your exporting sectors are going to take that hit. So the argument goes into 2-3 places. The other one becomes, oh, but valuations are good, growth is there. Well, I have seen stocks that grow 30% earnings and get a P ratio of 3 because the market doesn't know what to do. So it just happens. This is just history of markets. It happens. It doesn't have to make sense. Okay, so if this is the reason tech does badly, they'll get cheap, which means you'll get better prices. You should think of it as an opportunity rather than how is it possible. Everything is possible in the market.
Okay.
So now, sorry, I'll take a wide chart. Okay. So what you're saying in A equal to C is essentially pointing towards around 14,450 or so. So this is the AC section.
Yeah.
Okay. But within this AC section, if I actually do, now we have only done one of C. This is what my main point is. So far, this is one of C. Now, unless it just keeps extending, okay, it doesn't give me that bounce, which I'm thinking. Then, of course, it's different. You complete 5 waves still down here, which is around 14,580 or 14,600, somewhere there.
Okay.
But if this is 1 and 2, then I'll imagine 3, 4, 5 kahan tak jayega, because if this is one segment, let's say this bounces till this gap area and then goes down again, then 3 of C will only end up at 14,360. And then again, if there's another bounce and then there's another fifth, let's just extrapolate. If it looks like this, then by the time you're reaching the fifth of this, you'll be at 13,400. This assumes that 3, 1 and 5 will all be equal in size. But the easy part might be to also run in on extensions of C. So if you're doing this, let's do 1.618 times of C or 2.618 times of C. So let us see what those numbers look like.
Okay. Rohit, my question to you is, now the whole sentiment will be driven by inflation? So inflation figures?
So, that is what it was already. So just to highlight, 161% comes to 13,500.
Okay.
So inflation was already the narrative, I think, for the last 6 months. First, it was bullish for some sectors. Now it is turning bearish for some sectors. So now, but of course, whatever research I have seen says that inflation data will remain elevated till maybe even October or December. Okay, it may not cool off that easily because of various factors. It has nothing to do with only oil prices coming down or something. There are many other factors going into it, including the housing market, where rents are still showing an upward journey. There's still some wage inflation is still high in the US. Of course, we are talking of US, and food prices are still to come down. So the first part that is taking an easy hit is the commodity side, right, which is metals and now oil. Now, as oil falls, expectations of inflation coming down will start growing.
Okay.
But what I am saying here is, if we are at the point where oil and stocks start falling together, then you're gone from the inflation argument to the deflation argument as far as market is concerned. Data might still be in inflation, that is at the Fed level, at the policy level. Policy level, they'll still be raising rates till the inflation numbers start to change. But at the stock market level, you'll start pricing in deflation.
Okay. Okay, fine. So Rohit, if you can get sector-wise, please, starting with IT and metals and autos, before we start taking up the questions.
So some sectors like IT is, how I'm mapping it. Oh, it's going to be scary.
Or else you can just open our wavecon module in the website itself, and you can just quickly.
Yeah, so there it's in black and white. So now that it's a video, I can show it here on a white screen also. It will look better. It's not a problem. The only thing is, see, we were trying to think that C is over. Now, because like you asked the question, if US tech is going down, are we going down? So what I ended up doing, I'm putting the same count as I'm putting on the NASDAQ on the IT index. A, B, C1, C2. Okay. And that means this fall here is only 1 of C, 2 of C. So then you'll say 3 of C kahan tak jayega? Then I'll say 3 of C will be equal to 1 of C. So eventually it's heading to around 23,000, which is bizarre. Actually, I know it's bizarre. I don't know what to do till I get a trend reversal. Now, another way some people will want me to think about this. So we thought about it, but I'm not able to put it in perspective with US market, that this is 1, 2, 3, 4, 5 or ho gaya. See, if we are bullish, we can always come up with a bullish outcome. And then I should say 5 waves is over, why not retrace? If this is true, then we are getting a bigger retracement. Now, for a bigger retracement case, I'll just say one thing. See, actually, and bigger retracements did happen during Y2K in India. So if that is really still happening and I'm overlooking it, the answer will lie at the 20 DMA only. So if the Nifty goes beyond the 20 DMA, the IT index goes beyond the 20 DMA, then maybe I will consider the possibilities that something is complete and we are getting a bigger rally before we fall again or something happens. Maybe we are diverging from the US market as we have done in the previous bear also. So if that is true, I don't know if my other Nifty chart is open over here. Yeah. So if that is true and we are diverging, then it'll be that, I look at C, I can say that C is over here truncated. And I'm getting a retracement of this entire fall. So this was another thought. I didn't write about it saying till US reverses, let me not say. But this is the case. Now, ABCX, can I do an X wave which is 61% up to 17,000? Because everything is looking like kuch ho gaya. And some people think even a small cap count, why can't I take whole 4 and 5? Then will we get a bigger bounce? A bigger bounce is a hope. Right now, I will say that unless you can cross 61% of the last fall, which is sort of close to the 20-day average, which is, I think, closer to around 16,000 on the Nifty. So unless we can cross 16,000, I don't want to really go to this place of thinking that you are going to 17,000.
Okay. So let's start out with the various other sectors, Rohit, starting from IT to metals, if you can.
So metals also, like IT and metals have become the two more difficult sectors because in between they were looking oversold and now they are just falling like 9 pins. Okay. Now in metals also, we were trying to mark ki kahin pe 5 hoega, A hoega, then it extended. Now I'm thinking, is this 5 or is this just going to keep going on 1, 2, 3, 4, 1, 2, 3, 4, 1, 2, 3, 4? छोटा सा बढ़ेगा फिर गिर जाएगा फिर बढ़ेगा फिर गिर जाएगा. So it's actually getting a little tough in terms of the exact structure over here. Okay. Will we complete a larger A and get a larger B at some point or not? I actually don't know. If I'll go by international copper prices, it won't happen because copper is just done inside of wave C, just done the first 5-wave decline. Okay, it has still a long way to go down.
Correct.
If that is true, then it's not possible that copper prices actually, metal stocks actually do a big rally unless the stock market does a big rally. The only time metal stocks diverge from metal prices is when the stock market is doing something else. So I think so at a sector level, I've become a little confused in at least these two. There's a divergent pattern on so many.
Okay.
Some of the ones which are showing that a fall is still just starting are related to the energy, oil, gas segments. Those are the ones which are showing, we have just started to fall because their momentum indicators just went into sell. So which is why on Friday or Thursday, I think Jay put out this chart of the PSU index saying A, B or C chalu ho gaya. Okay. So this is an index where the momentum indicator went into sell here only just on the 15th and then it's fallen for 2 days. And C equal to A is still not achieved. So here it is easier to be bearish, okay, because you are doing C and you have an equality target on the PSU index. Same we can do with energy and power and so on. But we are not able to do that with metals and IT, which are just one way falling. कि कहाँ पे खत्म होएगा वो समझ में नहीं आ रहा है और ये सब अभी गिरना शुरू हुआ है. So how will the two play out? Will they fall along with this? Will the two diverge? So that sector level fine tuning short term has become difficult.
Okay. So last weekend with Indiacharts, Rohit, when we did the last weekend with Indiacharts, you did mention that you are 100% trading into index. Will you continue to do the same going forward?
Yes, it has become a little easier.
Okay.
Because a lot of stock shorts which I tried, they eventually worked, but in the short term they were not working and frustrating. Eventually, some of them did fall. Okay. And so then I took a call. So before they were not falling, I took a call to switch to index. At least that worked out. So it takes away the frustration of, market गिर रहा है, but ये stock नहीं गिर रहा है, मैंने कर दिया, but वो नहीं चल रहा है. So that thing, because I don't know, for some reason, unlike markets before, when market used to fall or rise, everything used to go up and down together. So I rarely used to get so much variation that, you'd completely fail if you did a wrong stock choice. Now that rotation is very high. And so the odds of being wrong at a stock level has become very, very big. So I think it's better in this type of bear market to stick to index. It's tempting to do stocks beech mein kar leta hu. Last week also I tried something, and then, so if I tell you the market was falling till Thursday, Friday, I thought it'll fall more. Whatever stock puts I bought, all I lost money. Eventually market fell more on Thursday, so it made up. But the point is, in hindsight, looked like what was the point of losing on those two trades? So this is what is happening. It's like somehow the rotation is just too killing. It eventually plays out. 10 days later, I see that it has worked. But at that point of time, in the very short term, a lot of things are going against you. So auto, like you mentioned, auto index has been one of them, because the auto index last month made a new high, and it after that also the fall is very, very lethargic. So I'll open the auto index just to show. So it's actually not helping in terms of being able to take a clean shot. Okay, it's fallen a bit, but it's nothing like any of the other indices. But largely speaking, if we are going into a bigger bear market in equity, the auto index cannot stay here. But that also reminds me then, I don't know how many people remember, the auto index went flat from 2006 to 2008. This is before the 2008 bear market. And even after the bear market started, I remember some stocks like M&M never fell till even September of 2008. They were going in a sideways triangle or something. बहुत बाद में fall आया. So it's maybe nature of the sector also.
Okay. Fine, Rohit. So let's start taking questions from the audience. So starting with Sahil Modi, if you're there, you can just unmute and you can ask your question, please.
Yeah, hi, sir.
Hi.
Sir, thank you very much for giving me an opportunity to ask you a question. I want to know your take on IT sector.
So
where can it go? And
I thought we just answered the question on IT. We just answered the question on IT sector. So what is your question specifically? His voice is cracking up.
Okay.
In this bear market. Actually, I was not available. Yeah, there is the net issue. Sorry, sir.
Yeah, so we discussed the IT index, and my sense is that it's not done with. Basically, we are in wave 3 of C. And IT is the sector most related with the US NASDAQ. So it's likely to take the biggest hit. So even if you take a 61% retracement of the whole rise, that comes into around 22,000 on the Nifty IT.
Next up is Mr. Ravi Tanwani. You can unmute and you can ask, please.
Good morning, sir.
Good morning.
Sir, अपने जो ऐप में गोल्ड का आपने व्यू दिया था, इन डॉलर टर्म्स कुछ बेरिश व्यू दिया हुआ था, और MCX में आपने भी कुछ अपडेट किया तो बुलिश व्यू अपडेट किया है. तो सर क्या वेव्स काउंट्स चेंज हो गए या दोनों में कुछ अलग वेव्स है, डॉलर और?
यस, करेक्ट, दोनों में अलग वेव्स हैं. और मैं एक्चुअली ये सोच रहा था कि ये अलग इसलिए क्या है कि USD INR का फर्क आता है बीच में
जी.
USD INR ब्रेकआउट करने की कोशिश कर रहा है, ऊपर तो जा ही रहा है, बट इफ इट टेक्स ऑफ फ्रॉम हियर, अगर वो 85-88 तक जाता है तो उसका जो पॉजिटिव रब ऑफ इफेक्ट होगा गोल्ड के प्राइसेस पे डोमेस्टिक में, वो शायद ग्लोबल में जो अगर $10-20 भी गिरता है, $50 गिरता है और यहाँ पे रुपया 84 तक जाता है, तो नेट भाव या तो कहीं नहीं होगा या फिर थोड़ा ऊपर ही हो सकता है.
ओके.
तो हिस्टोरिकली भी हमने ये देखा है कि जब भी करेंसी अपनी वीक होती है ना, तो रुपी टर्म्स में गोल्ड का भाव जो है कम गिरता है या फिर थोड़ा बढ़ भी जाता है. इसलिए रुपी टर्म्स में आई वुड नॉट बी टू बेरिश ऑन गोल्ड राइट नाउ.
बट सर ऑन डॉलर टर्म इट इज बेरिश ओनली ना?
डॉलर टर्म्स में इट इज स्टिल बेरिश.
तो सर एक इम्पैक्ट होता है डॉलर और रुपीस का, वो अपने MCX में आ सकता है. बाकी सर ओवरऑल जो वेव स्ट्रक्चर जो है वो गोल्ड में जो डॉलर टर्म में आपने ड्रॉप किया है तो वो बेरिश है.
यस 1650 या कुछ मैंने नंबर दिया है.
जी सर.
और उतना तो हो ही सकता है. इनफैक्ट इवन द गोल्ड बग्स इंडेक्स आई हैव गिवन एन अपडेट, क्योंकि पहले मैं गोल्ड माइनिंग के बारे में काफी लिखता था, क्योंकि मुझे लग रहा था कि अगर गोल्ड बढ़ेगा तो गोल्ड माइनिंग में ही ज्यादा पैसा बनता है इन टर्म्स ऑफ अगर डिलीवरी ले रहे हैं. तो बट ये गोल्ड माइनिंग का सेक्टर जो है, इसका जो पूरा चार्ट है, ये 3 वेज में कहीं जाके अटक गया. सो व्हेन आई लुक एट दिस बिग चार्ट, है ना, तो बिग चार्ट में ये चैनल के अंदर एबीसी के आगे गया नहीं. सो दैट इज वेयर आई स्टार्टेड टू डाउट कि ये कहीं एबीसी करके खत्म तो नहीं हो रहा है.
Okay. Next up is Rohit. Next up is Kunal. Kunal, you can unmute, please.
Hi, Rohit. I would like you to compare the bond yield cycles we are in between 2008 and now, because I'm noticing that in 2008, I think we went up highest to, I think, about 9.5%. And now if the rupee weakens, I mean, is there a case for the bond yields to keep going higher if inflation comes down? I mean, I'm just trying to see whether that will give us a, you know, a leading indicator whether we are in for a deeper recession.
Is your question related to Indian bond yields or US bond yields?
Yes, Indian bond yields.
Okay.
I'm just trying to see whether it will give us a faster leading indicator, whether we are into a deeper cycle or it might end sooner, you know, than we are anticipating.
Rohit, your voice is actually not coming.
Because I'm not speaking anything. I'm trying to set up the chart. 1 second.
Okay.
See, now what you're looking at is the Indian 10-year yield versus the Nifty. Now, can you ask me specifically now, Kunal? See, what we see here, see, bond yield spiked to this point. This spike was essentially, you notice, around June, which is essentially where oil prices peaked out. So we were raising rates till that point where, because inflation was still going up, I think we got 5-6% inflation in mid of 2008. The bear market was already on, and then once oil prices rolled over, then you notice the bond yield also sold off and bottomed here right after equities.
Kunal?
Yeah, I'm having some technical issues. Just I'll come back to you.
Okay. Okay, next up is Mithun. You can unmute and you can ask the question, please.
Yeah. Hi, Rohit. Great analysis in the morning. I was just seeing one chart of the 10-year bond yields in 2014 as well, where, you know, the dollar index during 2014 went up from 80 to 96, and the bond yields fell from 8.7 to 7.6, while crude also fell in that year. Just wanted to get your thoughts, because if you see the on the trading view, the government bond yield chart, we seem to be coming to the higher end of that range, and we may roll over. So just wanted to check any similarities between 2014 and now.
So you're comparing the Indian GSEC?
Yes.
With the dollar index?
No, I'm just trying to portray during that period where the dollar went up, the yields actually came down. You saw oil come down and markets did well. So I'm just trying to just are you seeing any comparisons between 2014 and now is what I'm trying to say, because even then oil moved up because of that Crimean war and all that. So
the only thing which happened here is the oil was already at 8-9%. Now we are not at 8-9. What
if you see the bond yields in a declining chart, but we're at the top end of that decline on the weekly chart.
So the way I was looking at the bond yield, yes, was more like this.
Correct.
The entire decline is in a downward channel and we are sort of at the top end, but what happens is
can we start going down at the bond yield with the crude coming down was my question.
Yeah. So even in 2008, I think when Kunal just asked me, that observation is right here, that this is exactly the point where oil went down, yields went down, but you notice even stocks went down.
Correct. But now I'm just trying to compare it to 2014.
So now 2014, you're saying that here also oils went. So I'll have to actually put on oil to get a sense of whether it is even comparable.
Correct.
in the first place. Let me just put oil on this and we'll see if there is any comparison.
So I think Brent was at 120 then.
This is NYMEX 1 month. Okay. So let me just put a vertical line. Okay. This is one point where oil peaked. You're talking of 2014 somewhere here.
Yes.
Okay. And we are thinking whether the same can happen at this point of time.
Correct.
Now, the difference therefore may simply be in the trend of the dollar itself.
And the dollar actually that year moved from 80 to 96. And still equity markets did well.
So they did well, I agree, for a short period of time. Remember, I can see this here. This is exactly when the elections happened and Modi came to power. Okay, around May of 2014 is what it looks like on this chart.
Correct.
So, yeah. So the market continued to rally because of that all the way till probably Feb. After that, when you see the final bottom for the year, and so this is another historical study I've published many times, is that oil and stocks fall together and bottom together. Okay, which is sort of what we are trying to say. If I have to look for a real bottoming buying opportunity apart from current rally, because see what happens is we expect things to happen point to point. Idhar ye hua to idhar hi hona chahiye. We don't consider that there can be a lead lag. So here what has happened is this is actually the bottom in oil prices. Okay, and what I think is that what ends up happening is the greater buying opportunities end up happening when oil prices also bottom. So if I actually compare all the bottoms in oil, you'll see how they are more important from a bottoming perspective. That is, this is a major bottom. This
correct
is an important bottom from where it rallied for several months and even oil went up. Okay. So rather not oil, sorry, bond prices, but oil also went up.
Yeah.
So as much as we think this is not good, I can show it the other way. That rising oil prices, rising bond yields, and rising equity, all was true, which takes you back to the first chart of mine: bonds, equity with commodity. Okay, we think that the opposite should happen. What I'm trying to fight is that opposite thesis doesn't exist. It exists only in a lead lag of 3 months, 2 months, where maybe because everything didn't happen at the same time, it feels like there is an inversion, but there is no inversion.
Right.
Because they are all economically related. I mean, economy improves, growth improves. Growth improves, oil goes up. Oil goes up, interest rates go up. These are all lead lag of the same theory that there is growth. If oil is going down, stocks should do well. But why? Oil is going down because growth is slowing down. So if growth is slowing down, rates will go down. If rates go down, market goes down. It's all related. It's not the other way around. Yeah, ये सब नीचे आ गया तो वो ऊपर जाएगा. No.
No, the only point here was since we've already had such a big correction in the US and Indian yields have gone up too dramatically in a short period of time, a small decline in the yields could kind of keep markets afloat. Was the only point here, because last year was a lot of the commodities going up because of supply side and all that. So if we
but you see, again, I'm showing the same thing. This is a drop in yields. Even here, there is a drop in yields actually from this top to this bottom. The only phase you are talking about is कि यहाँ पे yield कम हुआ और यहाँ पे market बढ़ा.
Yes, 2014.
So you're talking of a fraction of the entire correlation. So say, for example, something is inversely correlated for 9 months. But if I find within that 9 months, 3 months where it didn't happen and say, see, idhar nahi hua, and make that my thesis, it doesn't work, na?
Right, right.
So what I'm trying to say is that this is an aberration. What you're talking about is an aberration. The rest of it is all directly correlated.
Sure.
Okay. Thank you, Mithun. Next one is Mr. Rajesh Prasad. You can unmute and ask your question, please. Rajesh Prasad.
Oh, yes, sir.
Yeah.
Hello.
Yeah.
Yes.
Am I audible, sir?
Yeah.
Thank you, sir, for such a wonderful presentation. The way you have explained the sector-wise impact on the Nifty, it is very beautiful. I am very new in the market. Only 6 months experience is there. So this such a wonderful session for us. Thank you so much, sir, Srivastav sir. And
Pleasure,
sir,
pleasure.
can you show me that Nifty chart where you have label 5 on the Elliott wave? There is one question on that. There are two 5. One is 186105 and second one is 18305. 5 is
Correct,
there.
correct. Yeah, I'll just mark it because I think I closed that chart. I'll just put it on this. Okay, so one I had put over here and one I had put over here. Yeah.
Yes, sir. So, sir, suppose if I take a 18610 as a 5, okay, and then I will take A, B, C. That 1860 to 410 move is the A. Then next 5 is your B, and then it is C. A, B, and C. Okay, and then yes, sir. That A, B, and then C, and then I will take this is the X. After C, it is the X.
Yeah.
After C, it is the X. And then if I see this, once again, it is the A, and then B will be upward, and C will be once again deeper correction on the downside. So is it possible that, sir, any one up move is possible, and the larger correction may happen next year? Is there any possibility like this?
No, I didn't get the last part. After this X, what are you saying? ABC and over.
After this X, once again, this ABC is repeating. What happening from 18610 high, same ABC will repeat from X onwards. Same pattern. ABC
Sure, but you are saying after this ABC, it is over, you're saying.
No. Here this C is similar to phi 2A. First phi 2A, that X to C is nothing but similar to phi 2A.
Okay.
Okay.
You're saying this is over here, A. Yes,
yes. And then once again B. And then there will be a deeper sharp fall down to C. Is there a possibility like that?
Okay. Now, see, don't take this critically, but I will just tell you something, that there is something known as basics of Elliott wave analysis.
Okay, sir.
Okay. So when we mark A, what does it mean? So when you say A, see, right now, I will presume based on what you have done on the marking on the screen is basically you have never read a book on Elliott wave analysis.
Yes, sir, I'm very new.
So why are you marking waves without having the knowledge? This first step.
Okay, sir.
You are just saying ये follow गया इसको मैं ये कर देता हूँ. Based on what? So based on basically no knowledge of a subject. So that unfortunate problem of what happens is that this subject is very, very specific about what you mark as A and B.
Okay, sir.
Okay. To just give a basic highlight of Elliott wave for anybody who doesn't know why we use this theory. This theory means everything should be in a phi wave in the direction of the trend. If the mean trend is upwards, it should move in the direction of the trend in 5 waves.
Yes, sir.
And against the trend in 3 waves.
Yes, sir.
Okay. This is a basic requirement.
Yes, sir.
And therefore, and this requirement is at every degree of time, which means even inside this first wave, which is 1, I have to get 1, 2, 3, 4, and 5.
Yes, sir.
Inside this correction, I have to get A, B, and C.
Yes, sir.
Okay. So everything has to phi 3 if the overall trend is up. Now, same thing, if the overall trend is down, it has to be 1, 2, 3, 4, 5.
Yes,
and
sir.
only after I do 5 can I mark as A.
Okay, sir.
So when you're marking A on the screen, without even, I can simply see it over there.
Sir, in A, 1, 2, 3, 4, 5 is there. If you see,
it's not there.
If you see phi 2A,
you can see. You can see. Now I cannot see. Why I cannot see? I'll tell you. You are saying this is 1.
Yes, sir.
Okay. What did I say? Even 1 has to be 5 waves. Can you see 5 waves in 1?
But sir,
can you see 5 waves in 1? You have to answer the question.
But sir,
No,
ABC
but. No, but.
No. But
is 1 5 waves down? Is 1 5 waves down?
Okay.
If it is not your, if it correct. Yes, correct. You see ABC in 1, so it cannot be 1.
Okay.
So that is where lack of knowledge may you are just doing something randomly. I'm just saying. Okay. So therefore, why your count is wrong? Because it is not correct in the technical sense.
Okay, sir. Okay. And sir, any time frame for you? The suppose the deeper correction, is it happen this year only?
Yeah, I have written about the time frame. Basically, all the bear markets that we have seen, 2000, 2008, 2020, they are all lasting between 15 to 21 months approximately. So 15 months, say from the October high, gives us March 2023.
Okay, sir. Thank you. Thank you so much, sir.
Great, Rajesh. Rajesh, don't forget to read the book It's
Sure.
called as Elliott Wave Principle by Frost and Proctor. If you can read
Sure,
that
sir.
book, you'll get a very deep knowledge on Elliott waves. It's a wonderful book. Do buy
Sure,
it,
sir. Sure,
yeah,
sir.
and read it.
Sure,
Wonderful,
sir. This is learning for me. Thank you. Thank
Yeah,
you.
thank you, Rajesh. Next up is Rajeshri Dhar. You can please unmute and ask your question if you are still there, Rajeshri Dhar.
Yeah.
Hi.
Hi, Rohit and Chavan. Thanks for this opportunity. I'm an Indiacharts subscriber. So, Rohit, I just had one question. So now, obviously, like as you have explained, the macro has turned bearish, and then what should be the thought of an investor over here? Like, should we wait for the Fed to stop cutting rates and stop hiking rates, and then probably think of a bullish scenario, or like as investor? Because I'm not a trader, that's why I thought I will be asking this question.
So I answered it earlier that we are looking at the 3 cycles: bond, equity, commodity. Before equities bottom out, bond market will bottom out. So the first thing you'll be looking out for is a bottom in the bond market or a top in the dollar. Once those happen, then we will start looking for a bottom in equity.
Okay. Okay. So till that time, the best thing would be to be in cash.
I cannot tell you what to do. I can tell you what I have done.
Okay, thanks, Rohit.
Because we cannot give advice. So I cannot say you should be in cash. I can say I am in cash.
Yeah, got the point, Rohit. Thanks.
Okay, thank you. Next up is Manish Thakkar. You can please unmute and ask.
Hi, Rohit. Thanks. I'll go back to DXY and metal sector. Now, if I look at DXY and if I draw a parallel channel from joining two bottoms, recent bottoms, if I draw a parallel channel from the recent top, it is just touching the top channel, and the DXY on monthly or weekly, if we do, yeah, a very large
monthly time frame now. Okay.
monthly time frame, and which also works out to be around 38% of the entire fall.
So what you're talking of is this channel?
No. I'm talking about starting from 79.48 till 71.92. So the bottom downward slanting channel on monthly chart.
This?
No, नीचे वाला sir.
So downward slanting कैसे हुआ?
1992 to 2008 bottoms. नीचे वाला channel. Downward.
ऐसे?
Yeah. And if you something like that.
Okay, reverse channel. Yeah.
Reverse channel. Okay, fine. That works out to be 38.2% of the fall. And similarly now, since it is directly correlated with metal sector, and if I look at metal sector, say for example steel or disco, etc., you also said that it has come out of 8-year, 10-year bear, and this could be a first wave.
Yeah.
And ongoing move could be a second wave. If I look at steel, it's already retraced 61.8%. So I'm just trying to join these two data points and trying to foresee if dollar bear market is over. I mean, it could be ABC of dollar rise. Okay. And it could be second wave of metal sector, which could have been over by now. Because steel authority is at 61, disco is at 50% of the rise. I'm just trying to see if that is a possibility.
My sense, it becomes a little, what happens now that when we all do different kinds of analysis, it is sometimes difficult really to answer whether this is right or wrong. The only way I'll say it is, if you're right, let me get a clear sign of a trend reversal. Right now, down to even the daily or hourly chart, say if I say, this has come very close to this top. Last 2 days, you saw a fall in the dollar. I'll go to an hourly chart and say, can I see 5 waves down on the dollar? I cannot. It looks like ABC. Okay, and then it's rising again. So because I cannot see an impulsive decline, I'm still not able to think that a dollar is starting to fall again from this level as yet. Okay, so I'll happily question my thesis at every point of time by doing what I just did, looking at every time frame, checking whether it's still on, not on. That's about all I can do. So how do I really confirm that the metal sell-off is over? It takes me back to the commodity cycle. We have still not bottomed out in commodity prices. Okay, so no model can be single factor. So if I look at the dollar, I say dollar will fall, commodity prices will go up. Okay, so then I go to the commodity prices and I open the commodity price chart and I say, has copper bottomed out? Okay, then I say, okay, copper has fallen in 5 years from year to year. Okay, from year to year. So if this is A and this is B, then C equal to A is not achieved. It is much lower than this. So if it is not achieved, then has copper bottomed out? So then again, the answer is maybe not. And it is still to break this shelf support, which it is trying to hold or break. And if that breaks, then here, then. So if commodity and oil is just turning over from buy to sell this week. So if oil hasn't bottomed out, then commodity prices haven't bottomed out, then metal prices have not bottomed out. So maybe dollar is not topping out. So this is sort of, so there are many angles with which we can come to the same conclusion. So that is my answer. And every day I have to think about all those angles. Yes, no, yes, no, yes, no, answer is no. That is what we do at Indiacharts. Every day we post charts thinking yes, no, yes, no, yes, no. And our answer is no. So I can't say you're wrong, but as of now, I cannot see why it will be right.
Okay. Thank you, Rohit. Next up is Mr. Adesh Pawar. You can just unmute and ask your question, please.
Yeah. Hi, good morning, Rohit. Good morning, Chavan. And good morning, all. So, Rohit, actually, I have a question on the Nifty chart only. And, I ended up, in looking at the chart in two perspectives, because one camp is there who is, considering this correction as wave 4. And then obviously, your explanation with macro factor and everything, that we have already completed wave 5, and then we are in wave Y or C, which can go much deeper. I just want to know, since market is all about the probabilities, I just want to know where we can probably justify if we are wrong, and if we think that we are in wave 4 right now, and wave 5 may get started from that particular point. So what is that reversal point where we can see that this is not this is actually wave 4, and this is we haven't completed wave 5 yet.
Yeah, that's something that we should quell once and for all. क्योंकि अगर इतना बड़ा wave 4 है और इतना बड़ा नीचे ये पूरा extended move बना है, and this is 1 and 2, तो wave 5 होएगा कितना? मैं तो ये सोच रहा हूँ, if somebody is bullish for wave 5, is bullish for how much upside? Because there is very little upside in the wave 5. So anyway, that is just a detractive question to anybody who is still thinking that. The other part is, see, many times people try to ask this question, at what point will you say you are wrong? It's like, it's indirectly, that is a question. The answer is, I don't know. It'll have to be based on a reversal in so many, so we are tracking so many sectors, stocks and factors. They will all start changing. I mean, it's like the same way as the answer is should be in the reverse. If you have actually watched me remain bullish till April, despite the market having topped out in October, the question should be, what made you turn bearish? And so then that sort of answers the question, what will make you turn bullish? So it's always something, right? There's something in the charts, in the factors. The dollar, I thought, was in a dollar bear market from 2017, which means for 7 years, which means 2024. And here in 2022, 2 years before my dollar bear market was supposed to end, the dollar is breaking out to a new high, which means the whole thesis that the dollar was in a 7-year bear market is first wrong. So I have to first accept that it was wrong, and then I have to change my whole view on that. And similarly, in equity prices, I was bullish on metals. Metals topped out in April, so I have to first accept, yes, metals ka fifth wave is over. Okay, so let me open a metal chart. So if the answer was only based on a single factor, it would be easy. So I would simply say, if Nifty goes above 17,000, I am wrong. But the answer is not that simple. Okay. People want that answer. People want a simple answer. But the simple answer doesn't exist. So I have to look at multiple things as to why I'm thinking or not thinking something. There's some crazy people trying to do crazy things. I'm getting somebody wants remote access control. Somebody tries to draw on our screen. Some crazy people. If whoever sends that request again, I will ask Chavan to block him out of the whole thing. So please.
Can I know the name, Rohit?
Vinod, I think it was. I closed it without reading the surname. If it comes again, I'll tell you. Anybody does anything silly like that, this is a private session. We'll just throw you out now. So don't do. Okay. Unless you're not interested, then leave anyway. So this is the metal index chart. Coming back to your question. Okay, so this is the metal index chart where I was trying to anticipate, is this an ongoing bull run or is this the end of a fifth wave? So I look at the monthly chart and quarterly chart. So here also somewhere I first thought it is this 1, 2, 3, 4. Of course, in this marking 3 is short. But on the daily chart, have we completed 5? Or are we extending? And then somewhere it was, there was a big fight, 3 is complete or is this 3 and 4? The same argument which you're asking me on Nifty was there. Eventually, I have shifted it like this and completed 5. I had to tell myself ki nahi ho gaya. Abhi now after ye ho gaya, when I look at charts like this, which have distributed, topped out, rolled over, and I am saying nahi Nifty mein fifth wave baki hai. So you show me one sector index na jahan pe fifth wave baki hai. So it comes down to that. So then I have to really prove to myself. Apart from my other argument will be that there is something in wave theory known as ki there has to be symmetry between waves. If wave 2 is 1 day long and wave 4 is 6 months long, do you think they're even comparable? You think this is wave 2, this small little 3-week correction, and this 6-month correction is wave 4? Then congratulations to the person who's saying that. Give him an award for Elliott wave.
Right.
Okay, thank you. Next up is Chetan Jain. You can ask your question, Chetan. Okay, Chetan Jain is not there. Next up is Prasanna K. You can unmute, please. Prasanna K.
Thanks, Rohit, for the wonderful session. What I would like to know is, now we are in a downturn, that is sure. So what are the sectors we can hide in, because we can't go 100% cash?
Why not? What prevents anybody from going 100%?
Still, I have to change my investor mindset in that case, I think. And of course, I have been an Indiacharts subscriber since last 4 months. It has been very insightful. So I at least come to a 40% cash, but 100% cash is still unbelievable for an investor like me who has been in Indian markets.
Fair enough. So there are different ways that people can work around it. See, for example, now I know you can see the biggest problem will be if I say that I cannot do anything. If I can do something, if you have an existing portfolio which has certain A group stocks that are listed in FNO, you can do something which is known as covered calls, which means you can sell call options versus the stocks that you're holding and keep reducing the cost of your holding. So sort of you're hedged. Okay. Because options, when you sell, you get 3 to 4% premium every month at the money or slightly out of the money options. If you go one strike out, you get 3 to 4% in premium. 3 to 4% premium on your underlying stock is a huge dividend to give yourself every month. In 1 year, it is 40%. So sort of, see, protection methods are there. Question is what you want to deploy. If you don't want to sell your portfolio, you can sell call options versus your portfolio. You can have a currency position, which is, I can be bullish on USD INR. So even if I have partly some stocks, because I'm not 100%, I'm say, if I say I'm 80% cash, I can have contra positions of certain types, which can protect the cash part of the portfolio or whatever. So, so think about what is suitable for you. I cannot tell you should do this or do that. But options for people are to write covered calls, to have a currency long dollar exposure in USD INR, or whoever is comfortable would buy puts every month. I mean, but then that is again up to what percentage of your portfolio is a decision each one has to take individually. But those are different protection measures that are possible. See, the importance of, so there was a last question, that this being a triangle, I'll just tell you the risk of taking this view. Let's just know, because I sound harsh, so let me now sound soft. Let's say I am wrong and this is a fourth wave. The risk of a triple topping pattern is very, very high. Okay. So if I have to take a view that this is a triangular pattern which is bullish and market is going up, I might as well do that in hindsight by the time that my weekly indicators go into buy mode. So let us make this a technical question that I can answer. So which means my weekly indicator over here has to give me a bullish signal. Okay. Ideally on the monthly chart, I should go back above the 20-month average and close above it. Okay. So let's make these technical observations. Okay. And which means that around what 16,000 kuch hai, 16,000 ke aspas hai 20-month average. So I need a monthly closing above 16,000 to say that, okay, we are not breaking down right now. And why would I? So one thing is to preempt and one thing is to be on a back foot. So when do you preempt? When you're very sure, like March or April or even June 2020, I'm bullish and saying upar jayega. That's at least 61% is 10,500. We'll at least go there from 8,000. So that is being front footed. Why? Because you have a setup that says so. Here the setup that we have, very important to understand, this is a disaster setup. Triple top with triple, just because it is downward slanting, some people feel it is bullish. That's the only reason. All other expanding triangle patterns have been upward slanting and resulted in major crashes. Like right here in front of you on the left-hand side of the chart. Just because it was upward slanting, you are not anticipating कि यहाँ से bottom होके ऊपर क्यों नहीं गया? Ask someone, ये triangle भी हो सकता था. But all these distribution patterns occur near the top, expanding or contracting triangle over a multiple months. They break very harshly on the downside. Okay, like this. This is what happens. Not only in our market, it happens in any market. So here also, say 2008 top. What was it? It was an ending diagonal. Here like this. It lasted for 3 months. Go to a daily chart, and after that 3-month period, when it broke this level, in 3 days you were down 30%. Okay, why only that? You go to, since we are talking of Nasdaq bubble, this is 2008 housing bubble. But what was the Nasdaq doing? Expanding triangle on the way up. Now somebody could say, no, this is a triangle, fourth wave, it will go up. But when it breaks, it just breaks. Okay, and then it marks that a major distribution is completing. So this is what I am worried about, that it can be a major distribution completing. So that is why I will not go on a front foot on calling that as a consolidation pattern. Ho jayega agar, if the trend reverses, I'll accept it. It has reversed. But the risk of it breaking down and collapsing is much, much bigger, which is why I will not do that on a front foot. Go on.
Okay, Rohit, there are a lot of people who are asking on cryptocurrencies and especially on Bitcoin. So my question to you is, has the bubble busted on the cryptos?
It's a very tricky spot. So I'll just mention the little I know about cryptos. The whole hope around cryptos is that here I have the crypto chart right here. See, the whole only thing I could figure out, and you need to figure out whatever crypto you're looking at, where is the value proposition? The hope, of course, was that it will get adopted as a money. Now, why will any government or central bank adopt it? So it's never happening. Bitcoin, at least I know this much, that it was built around the idea of energy. Okay, so you burn so much oil, you will produce one crypto. Next year, you have to burn more oil. Next year, even more oil. So basic point was that you have to burn more and more oil to produce one more crypto, because to solve that equation, to produce one more Bitcoin, you have to burn more oil. So the whole thesis was so there was a cost of production. So you can put a base floor. 2 years ago, it was at $1,000, then $1,500, then $2,000. Maybe today it's at $3,000, where I've put the support. So say the cost of producing one Bitcoin today is $3,000. So at least you have something like book value. कि हाँ चलो 3,000 is fair value क्योंकि produce करने का ही cost है. So it will go plus or minus of that. उसके नीचे गिरेगा, you can say undervalued, उसके ऊपर overvalued. Can you say that for every cryptocurrency? Do you know the formula of valuation you can apply to that particular crypto? If not, then it's definitely a bubble, because the way crypto rises or even this valuation is calculated it's a mathematically created bull market, right? Because mathematically you have said you have to do so much equation equal to one Bitcoin. And so the value keeps rising every year based on the cost of production. And so that is mathematically ingrained inside the price key. Its price will go up because of this factor. And then you're trying to bet on that with real money. So at some point of time, once enough has been created, if there is truly a cap on the number of cryptos you can create or number of coins you can create, then it will flatten out at that point, because there are only buyers and sellers. Then it's purely speculation. Beyond that, it is nothing, unless adopted by some country. So now it's a tough call. It was a good trade because it's moving so violently and everybody's participating. And the Elliott waves are working perfectly on it because everybody's participating. Elliott wave is nothing but a study of mass psychology. And if masses start to participate in anything, be it crypto, Elliott wave analysis will work. But after you complete 5 waves as shown on this chart, there is a risk of unwind. Now, the bigger risk of it shutting down would be if government comes and clamps down. But we're already seeing many other cryptos where the valuation models were unknown, or where they were fraudulent, or where they were Ponzi, that are simply going to zero. Okay, if Bitcoin is not zero, it's only because the cost of production is embedded inside with an oil factor. But that cost of production might still be close to only $3,000 or plus or minus. I haven't checked the latest cost of production data, but I'm just giving you an idea what is happening. So it's nothing more than an oil derivative instrument. Look at it that way.
So you're looking at Bitcoin at 3,200, Rohit?
That's the fourth wave of lower degree.
Yes. Yeah. Okay, fine. So next up is Vivek. We'll have to hurry up. Vivek, you can unmute and ask your question, please.
Sure, thank you. Rohit, my question is that we have been using some, indicators, right? Daily, weekly, etc. Which is some indicators we use as a 20 DMA, and some we use as a, some as a simple moving average and some as a exponential. If you can help me understand that when to use exponential and when to use, simple moving. And I have another related question. If you first explain this, please. Thank you.
So the choice is very, very personal. The only important thing is using a minimum of 2 moving averages. Some people can use 4 also. 2 moving averages of different time frame, because in the study of cycles, you want to study different cycles. We all believe that market has different cycles: a 5-day cycle, a 10-day cycle, a 20-day cycle, a 40-day cycle. So if it has different cycles, to study different cycles and their interaction with each other, we therefore choose indicators of at least 2 different time frames. So moving average convergence divergence like MECD is based on the difference between 2 moving averages, like a 9 and 21. Okay. And probably both are exponential. Now that's a choice. Now on my charts, so some people will use simple 20-40. I use 20 and 40 exponential. Some people use 50 simple. It actually doesn't matter much, apart from 40-50 will vary a little bit here and there. And simple exponential, the main difference is exponential moves a little faster than simple. So because 40 was a longer time horizon, I chose exponential. Okay, there was no other reason. And 20 was because it comes with Bollinger Band as a standard plot. Moment I plot a Bollinger Band 20, so screen pe aa gaya. So I needed one more. I said 20 ke jagah 40 le lo, which is a higher time frame. And some people ask me 50 kyun nahi? So it doesn't matter. 50 kar lo. As long as you're using 2 which are significantly different from each other, you will get, once you get hang of it, you will become comfortable with 50 only. Then you always use 50. I became comfortable with 40 exponential, so I always use 40 exponential. There's no other reason than that. There is, of course, a backtest that I found in a book called Encyclopedia of Technical Market Indicators that backtested all indicators for their best outcomes. And 14 RSI, which is the standard, was one of the outcomes, which was based on the Dow. 20-40 simple was another outcome, that if you use the 20 with 40 as a buy and sell, you get the best results. So these were actually backtested results that probably led to the use of these indicators in this way. The rest is a minor variation we do here and there.
Okay, thank you. Next one is Mr.
He had one more question, Chavan. Okay, he said he had a follow-up on that.
Yeah, Vivek, if you can.
Yeah, so the other thing is, when we use these indicators, right, and especially when you look at the FNO and try to put your stop losses basis the indicators, this, as I said, variation between, let's say, exponential or moving average will matter, or 20 versus 21 will matter. That's one. And the second thing is intraday. So this, I'm assuming if it's a daily, right, we have to look at the closing price, right? But many a times when you put a stop loss, right, you don't wait for the closing and you have to put a stop loss in between, because by the end of the day, the loss might have increased too much. So I'm just trying to understand that how do you manage this with risk with the indicators?
You asked me a question that I would have to spend 2 hours explaining. Because how to put a stop loss is a full subject. We've taken entire mentorship session 2 hours, 3 hours to explain it to people ki kaise karna hai, because it's not only based on moving averages. For me, moving averages is one of the tools. I use my Elliott wave count. I use moving average. I trail with a even the higher high, higher low swing highs in combination. And I do give importance, as you said, daily closing, but then daily closing is important. Whether it's daily or hourly is again a choice. Then I'll also combine 2 time frames, which is say 2 different time frames. So I will use a daily in combination with hourly. So if I'm trading for a 5-day time frame, if you feel that the daily will take time to confirm, I will use the hourly time frame as a confirmation. But I have to build that methodology of how to trail and exit.
No, I mean, agree. I think it's not just one indicator. I completely agree, right? But just say you have decided that I want to go after, let's say, 40 or a 20, right? Either daily on every or hourly basis. Now, the question is that, for example, it's 1900 is the stop loss as per the 20 DMA, right? I'm just hypothetically using example, right? So do we put exactly at 1900 or you put some 2050? I think
that's a good question. I got your question. So the answer is that when you use things like trend lines and moving averages, okay, these levels have to be broken on a closing basis. On a closing basis for the particular time frame. So if it is 20 DMA, unless on a daily closing basis I don't close below the DMA, it is not a trend reversal. So even if I say, okay, 20 DMA is at 1900, it has to close below 1900. Intraday it goes below 1900 has no meaning. That is a false signal. So unless it gives me an actual 3:30 p.m. close below that, it is not a reversal. Now, if it is an hourly chart, then it will be hourly. Every hour it has to close below the 20-hour average. So unless it closes on below the 20-hour average, and same with the trend line. Now, if I'm using a high or a low, then it is intraday. So if I say, most recent top was 220.20 and market started to fall from there. So after it falls 2-3% from there, I shorted and I put a stop loss at 220.10. Will I wait for it to close above 220.10? No, because when I use a swing high or a swing low, I use it on an intraday basis. Even if it goes above that 0.001 gaya. So there's a difference on how you use intraday levels and when you use indicators and trend lines. Highs and lows can be intraday stop loss. Indicator moving averages and trend lines have to be on the closing basis. Otherwise, it's a false signal.
So if you have used the 20 DMA 1900, right, and since you are waiting for the end of the day closing price, in a 2 p.m. market starts to go downwards, right? By the time the day ends, right, you might have actually incurred quite a bit of loss in your forward.
Absolutely. So the only way you will solve that is position size.
Got it. Thank you.
Okay. Thank you, Vaibhav. Next one is Mr. SP. SP, you can unmute and ask.
Good morning, sir.
Good morning.
This was a fantastic analysis session. Thank you for that. I want to take your attention to KF long wave. Where do we do Indian market and US market are now in KF long wave?
Good. I wanted to show the long-term chart. So good you asked. This is a chart from, of course, Vivek. Vivek Patel doesn't do classic Elliott wave. But the good thing he's done is he's made this historical chart using RBI data and British advisor data, which goes all the way back to 1940. So you actually have a historical context of the Indian stock market over the last 100 years, or if not 80 years. Okay, so when I do that, the comparison I make with US market is that we are approximately around 10 years behind US in terms of the economic cycle. So US went through the high inflation period in the 1970s. India went through that in the 1990s. Okay, where we had very high inflation and very high interest rates. After that, both interest rates have peaked in both nations, then both went into bull markets of their own. So ours started in 2001, they started in 1980, which is 20 years earlier. But slowly that time difference is, I think, contracting to 10 years. So they went through the GFC in 2009, we went through the ILFS and other NPA crisis in 2020, 10 years later. So I feel we are somewhere 10 years behind them in terms of that cycle. So somewhere, when they started this MMT nonsense after 2020, I tried to think whether India's economic winter is over or US is over, because they've already done the debt part, banking side of the debt crisis has already been taken care of by write-offs, both in the US and India. And so the only problem is left with government debt, which is sovereign debt, and that may be solved through inflation. So therefore, are we past the economic winter part of the quantitative cycle and are we entering the spring, which is the new bull market. So I had a fair thought to believe that is happening. Right now, I'm in a confused part as to whether it's happened or not, because inflation failed. Okay. But economically, so it can be the case that economic-wise, we have passed that point because the bailouts for banking system are done. Okay. We have just not gone past that point from either a stock market perspective or from actually an economic, from a, bringing down sovereign debt perspective, which can be done in a different way. So we are somewhere in that transition only between the winter and spring. Okay. At least the banking crisis is sorted, which means that we are not going to end up in another banking crisis. I think that much is clear in both India and US. US also, people don't feel banks will go through a similar crisis. They are going down because of no growth. And so in India also, anybody will tell you banks' balance sheets are cleaner than before, which was also true in 2001, because even though we had a lot of NPAs, most of them had been written off for the PSU banks. So written off means already taken into account on the book. And so there was no more loss to report. So once you reach that point where that is done, so that is not, banking crisis is no more the issue. So we are in that transition between the winter and spring starting. Maybe the spring is started. That is why I'm saying wave 1 for all these sectors, which is broken out. And we are only in wave 2, which means we are in very early stage. It's like this now, 1 and 2 back here. But of course, this 1 and 2 was very long. I'll hope it's not so long in time. But time is not an accurate science.
So you are saying US market is also in transaction?
US market, that's a tougher one to answer. But it could be. But it could be. So again, earlier also I mentioned I will not go the Proctor way of marking this bear market as 1, 2, 1, 2. Is presuming that the inflationary model, to some extent, the ability to write off debt overnight is there. I mean, they did it with Greece. If it comes to a point where it's a crisis and there's no solution, they'll just do it overnight. And if they do that, then what happens to asset prices? They'll just stop over there. So therefore, having an exponentially bearish view. So let me just open the Dow chart. This is the Dow chart all the way from 1920. Okay, so what you fret is, will this happen? But this big fall of a deflation only occurred because the government said marne do. That is a fact. When I read history again and again in every book, that's what I understood. That Herbert Hoover was the president that said, no, we'll not bail out banks. It is their mistake. If you let your banking system fail, it will fail. But the fact is, right now, we've already built out the banking system. So if we've already built out the banking system, should we anticipate that, as EWI would want it, Dow will go to, earlier they used to say 1,000, now they'll say at least 6,000, which is back to the previous fourth wave. But I think that a smaller degree, what happens is many times these bear markets don't go below the previous low because government steps in. So previous fourth wave, I will not take as 2008 lows. I will take it as the most recent bottom, 220, which is barely at around 18,000 on the Dow. Okay, so maybe you go a little below that, go down till here, 15,000. But I don't think you'll deflate beyond that. By that time, they'll step in and do something. I mean, you'll need World War III for that to break, actually. So I don't think that's happening. So that's why I don't take that perspective. Only thing is, so your question is, are we transitioning? I think economically, in terms of the banking sector has been through its crisis, because this 1929, this was banking sector crisis. You had bank failures. 2008, you had bank failures. In India, 2018, you had bank failures. We are past that point, for sure.
So should we say that we are in spring or what in US?
In economic terms, you may be, but in stock market terms, you might still not have completed something.
So, but when we look at the inflation before spring, that is 1947 and 1949, that was a spike of inflation. Is it similar of what we are looking now? Because that was of Second World War. Now
so Second World War ended in 1942, after which they started to stimulate, and they were able to do that till what you're saying, 48, 49. Here, what has happened is कि 2 साल ही नहीं हुआ है, already dealing with inflation. So they couldn't do it long enough. If they could do it for 8-10 years, then the situation would be even better, because you would have brought down, by inflation, you would have brought down the debt to GDP by a much larger amount. because it's only been 2 years, the debt to GDP of the government has not come down by much. It is right now at 126% versus 129 or 130. So 4-5 percentage points, they brought it down with inflation, but after that you have a problem. And now suddenly you're again raising rates. Now, will they keep doing this back and forth also? We don't know. Now inflation will come down, again they will try to create it. What if they keep doing that back and forth? Then you will have a volatile market. कि वो गिरेगा, फिर वापस चढ़ेगा, फिर गिरेगा, फिर चढ़ेगा. Let's see how it's going to end. Will they give up? Because for a bigger crash, they have to give up. If they don't, you will keep getting bull market, bear market, bull market, bear market every 2 years.
Okay, sir. Thank you.
Okay, thank you, SP. Next, 1 second. Okay, next up is Neeraj. You can unmute and ask your question.
Hi, Rohit. Thank you very much for a very good seminar. As we've spoken earlier also, my question is only on aluminium on the London Metal Exchange. And as you said, that the the commodities are in a 5-way decline and supported by the Bloomberg Commodity Index, like we just started wave 2 and we might go much deeper. What is the final price you can see on aluminium coming on the London Metal Exchange?
Jay, you want to take that? You can open your metal charts.
Yeah, sure.
I'll just stop my sharing.
Yeah. So this was the wave count with which we were working. Okay, and now after this 5-wave advance, you have finally seen a 5-wave decline as well. So in which within wave 5 it is extending, and now it is almost trying to achieve the equality of wave 1 as well. So at some point of time, when this 5-wave advance is complete, you might end up getting a retracement. Okay, then how bigger will be the retracement and all, that we'll need to work it out. But if I simply go by this 5-wave rise, okay, so right now it is around the 61.8% retracement. So whenever this fall occurs and whenever we get the wave B, so maybe at that point of time we.
What is 78% then? Just give a number.
Yeah, sure. So 78.6 is probably around 2000.
Okay. So see, so what I would sense is, like, I can see in your 5th wave 1 2 1 2 3 4, which means 3 4 5. Some small bit is left.
Yeah.
Okay, which may coincide with the oil decline. Then when you get a B wave, let's anticipate that it won't go above the 4th wave. Okay, because my sense, bear markets in commodities, you get shallow rallies. Okay, so most probably you just go back to the 4th wave of lower degree, and then eventually you end up at 78%. This is what it looks like, I think, right now from the structure so far.
So, like, can we take as what you had given in one of the earlier reports last week as 2431 as the base from where we can turn around?
See, it is a level now. I actually have to see wave C completing 5 waves now. We can always analyze at that point of time. Right now, we are keeping that as an objective.
Okay.
If a 5-wave decline is not complete till 2000, I'll have to lower the bar, but I don't know that today.
Okay, so
what if wave B is bigger? What if wave B is a bigger bounce? Then C ka level will also change. So we'll take that as it comes. But this helps us in having some perspective. See, 61% is done. So clearly 78% is open. That much we can say.
Yeah, but 61% is coming at around 2431 levels.
वो तो हो गया ना, तो basically wave C में 78% आएगा.
Okay. So before that, we can get a bounce and then come to 78%.
Yeah, it won't happen right away.
Okay.
Because 5/5 is already near completion now.
Okay.
Yeah.
Okay. Thank you so much, Rohit.
Next one is Mr. Harshil. You can, Harshil, you can unmute.
Hello.
Yeah.
Good afternoon, Rohit, sir.
Yeah.
Sir, we are very blessed to have a mentor like you, and I really respect you very much. It's really a blessing on our part, and God bless you, sir.
Thank you.
And just I want to ask one question only about PSU Bank, sir. I'm following it since last 3-4 years. as it is fundamentally, if I talk, they have mostly their PCR is about 85 to 90% and mostly covered. Their NPA cycle is also in a point of finishing only, high NPA cycle. So what's on your view about that particular index and stocks like Canara Bank and Indian Bank, as I followed it?
Harshil, we don't take stock specific questions.
It's okay.
We
Sir,
will
index,
give you an
index.
overview on the PSUs. Rohit, if you
Yeah,
can just-
index, PSU Bank
index.
Index. Yeah. Is it a long-term bottom made and multi-year bull market can start in that stocks? As I am thinking about that.
Rohit, you'll have to do your screen share, please.
So this is the PSU Bank Index chart. Okay, right now we are working with the presumption that 2020 worst is over. And this rally was wave 1 and we are in some kind of wave 2. Now with wave 2, you can do 61%, you can do 78%. Is it done? Doesn't look like it is done. So if I take it from here also, 61% for the PSU index is at around 2000. If it gets worse, then I have to consider 78 also. So yeah, but definitely 2020 was the lowest point. What we're ending up with is a deeper correction, is a second wave correction as of now.
Okay, sir. Thank you very much, sir.
Yeah, thank you. Next one is Gaurav. Gaurav Hasija, you can unmute.
Hello, sir.
Yeah, hi.
Sir, earlier you said that Bitcoin is a leading indicator for the market. In last 2 days, Bitcoin fall around 13%. How you see the effect of Bitcoin in the coming week for equities?
So yes, Bitcoin has become a leading indicator because of its correlation with the dollar. So what I showed on this chart is every time the dollar has gone flat or down, Bitcoin has gone up. And that sort of happened because speculators have become interested in it rather than bankers, who would have been the ideal place for a currency. So basically what has happened is it reflects the market sentiment only. Okay, when market is bearish, Bitcoin also falls along with everything. So liquidity is tightening. So in the very short term, Bitcoin setup also is sort of become an indicator that yes, we are in a bearish trend. It's sort of confirming. Now, I will not expect day-to-day correlation with Bitcoin. Okay, it shouldn't be that high. But the Bitcoin trend does give me an idea of the overall underlying trend in the market. So that's how I am actually looking at it. That any move that occurs in Bitcoin sort of tells me about what is happening right now.
Can we move on?
We've already given levels. I think C, ABC for Bitcoin right now going on. So we can just check that chart out. I think this is already looking like, in fact, this is looking like 5 wave. Just like we are looking for 5 wave and bounce everywhere in the very short term. I can see now just looking at this can be 1, 2, 3, 4, and possibly 5, or it is 1, 2, 3, 4, 5 inside 5 also. I don't know. But yeah, the third was the largest, so that is done. So, but that can only mean small bounce and then again continuation is how I think right now. Everything is like that. Yeah.
Okay. Next one is Mr. Himanshu Shekhar. You can unmute and ask.
Hello, good afternoon, sir.
Good afternoon.
It was rather revealing that during your presentation, Bank Nifty never came into the discussion in your discourse. So, which was the leading sector earlier. So, does it say something about the cycle of? I'm talking in terms of stock market only, because it was the leading sector, and always in your earlier presentations, Bank Nifty used to be a major point of discussion. So number one, I want your perspective on Bank Nifty and banking sector, and then the levels of Bank Nifty where you see it going.
Yeah. So yeah, because when I do the long short report, which is more longer term, I think the focus becomes more Nifty than Bank Nifty. That's the only reason. Otherwise, as I mentioned earlier, there are reasons to believe the banking sector is in a better spot. But having said that, economic weakness hits banking sector. So the banking sector will go through its own pain because of the slowdown in growth. So looking at the structure, Bank Nifty's 5 wave advance from the 2020 bottom till October high looks like 5 waves. The fifth wave was small, so it is truncated. I was expecting it will be bigger than it didn't end up being. So eventually I had to think that this last part is just so much only 5. Then from there, from October, it is in a complex correction. So far, I have marked it, this chart, I have marked it as WXY. The alternate I have been trying to think is maybe I take it as, in this case, I can do ABC. So someone was asking me whether it can do A in Nifty, but in Bank Nifty, you do have a clear 5-wave fall here in wave A. So it's possible to even think of it this way. And the only reason to start thinking this way is that it would then end up aligning with the Nifty in the current stage where it would be in wave Y of C. So if we are still in wave 5 of C, again here, there is still downside left. If I take the immediate structure, the same 5-week decline, C and A would be equal towards around 30,600. Okay, and that may not be the end of it because this is wave Y. There will be X and there will be Z. There's also the risk that Y can be extended, just as we said in the case of Nifty. And in terms of larger retracement, if I take 61% of this entire move, then 61% comes in at around 26,700.
Thank you, sir. Just on a broader perspective, the effect of interest rates and bond yield and currency has a direct bearing on a banking sector. So if you take into account, right, it's fine that their balance sheets have been cleaned, but still there will be a major impact, I believe, of these factors like bond yields and interest rates. So I guess I sense a kind of, you being relatively less bearish on banking. So what is the reason for that?
No. No, it's not. I'm not being less or more. Yeah, I think I'm just. I just got that. I don't know. I think it's just coming from market behavior itself. That for some reason, banking stocks are not falling that sharply. Also, they had a correction earlier, but after that, they have actually not been falling. Maybe it is temporary. Maybe the pace picks up. We can actually visually see a head and shoulders here. And remember, I said in wave Y only the biggest moves happen. So if this head and shoulders neckline for Bank Nifty breaks, it could get worse. And which is why I switched to this white chart just to show you that on a very long-term basis, I can actually think, why shouldn't this be overall 5 waves complete from 2009? It's entirely inside a channel, top end of the channel, it topped out. So why shouldn't we go back to the bottom end of the channel, which is at around 20,000? And just like in Nifty, if it is 5 waves, why can't we go back to the 4th wave of lower degree, which means revisiting 16,000? But I'm saying we'll go in the same way as in Nifty, we'll go step by step.
Okay.
Let's take 61% at least to start with, which is at 24,000 and 26,000, and then we'll see.
Okay. Rohit, last couple of questions. We can wind up. Ashwin, you can please unmute and ask, please.
Thanks, Chavan, and good afternoon, Rohit. So my question is related to the sentiment indicator. So I think we talked about the technical aspects on the charts. What is the current trend and what's the risk that we are going to see? But what I also wanted you to check on the sentiment aspect. I am taking the US sentiment data as an example because that has more data than the Indian indices. So the consumer index sentiments, right? For example, there is the University of Michigan sentiment data, consumer sentiment data. That's kind of at the bottom now, and we have the asset managers sentiment data, which is hitting historical lows, and we also have the trader sentiment indexes, which are actually hitting the AA bull bear ratio. That's also hitting lower points again and again for the past 2-3 months, right? It's consistently at the lower levels. So is there any chances that we are actually seeing some kind of a selling climax around in the US markets? Probably.
Sentiment is such a varied question, which is sort of why I'm opening Elliott Wave International. Can come up with very, very, very different pieces of sentiment data to actually look at it and as more bearish or bullish. Like now, if I look at the VIX, if there's so much negativity, this is the US VIX compared to where it was in 2020. It's nowhere. In fact, even compared to this in-between period, it is nowhere. This is, of course, not the VIX itself. This is a spread between 1 month and 3 month futures contracts. So basically, the point being that across time frames, people are not in panic. So EW has its own set of measures, which some of which can say so. Now you say, allocation by cash allocation by funds. This is rolling over from the highest level here. It's not back to where it was in 2020 or in 2012. Definitely not where it was in 2009. तो क्या डेटा देखने का नहीं देखने का, सी इंडियन मार्केट एटलीस्ट व्हाट आई ट्रैक आई कैन नो. US market, though, there's so much data that sometimes I don't even know whether it's been presented for the case of being bullish or whether it has any real relevance, because it should be checked based on the time frame of study. Okay, what works in what time frame should only be looked in that time frame. So some indicators will go bullish, bearish at every top and bottom. So then they don't have long-term implications of, they might just have short-term implications. So I don't know how to compare with US, because there were a lot of US market data which was already very bearish even 3 months ago.
Correct. Yeah.
And it is still falling. So what should I do with that? So see, in bull markets, the other thing we know, bull markets keep going on when everybody is bullish also at some point of time. The same is true with bear markets also. Take our own market. I have published this data of FII and all, right, 2 days ago, if you are a subscriber and seen it. So I'll just open the FII positioning. FIIs were maximum short based on historical perspective. Now, should I take that to mean that the market is bottomed out? That becomes the next big question. So I'll just and the opposite side is client data, which is yellow, which is also the highest since the pandemic. So if you just see the yellow data here, it spiked. This is in the pandemic, which is the long positions in client data. And the blue is, of course, the FII data. Now I'll just remove the yellow one. Okay. Now we're looking only at FII, so no confusion. If it is not clear, I'll just thicken it up. Okay, so now it's bright enough for everyone to see. This is the lowest, near lowest reading or highest since pandemic short. Every extreme short position historically, if I go all the way to 2012 when the data became available from NSE, every extreme short position more than 1 lakh contracts short by FIIs was a market bottom. So this is a market bottom, 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 and so on and so forth. All of these are market bottoms. So why shouldn't currently be a market bottom? Yeah, it can be. The only funny thing is none of this data is during a bear market. 2008 is not in this data. It was not, the NSE started giving this data only after 2012. So then I'm not comparing current with, say, if I say this is a Y2K bear market and I don't have data only to compare. So I don't know what FII behavior or client data behavior would be during a bear market. But one thing to me from at least recent points is that what you see here is that they're continuously on the short side. Okay, you get the small jumps in between. Market rallies a bit, position goes to zero, again they go short. Again position goes long, again they go short. Again position goes long, again they go short. And this may be happening expiry to expiry. So if you see it as a pattern, this is February, this is March, okay, this is May, this is current. So in between it is happening repeatedly, except when it rallied. So when it rallied here or rallied here, it went up. Here even this small rally went to zero. Now it is short. So it is extreme short. I can say, okay, it is time to rally a bit. But does that mean it is time for a trend reversal? It could have been a time for trend reversal even in May, and we are still down. Or what if it goes up and goes down and they go short again? So all I will read into these data points is as you know, whenever it reaches this lower extreme, I will expect a short-term bounce. So yeah, next 1 week market can go up. After that, they may go short again. Who knows? There's no reason that they should, just because they are short, it is bottomed out. Because if this is a bear market, because we've not been in a bear market before. And again, surprising part of this data, which I have not figured out yet, is you'll notice that all this data has gone to the bottom end. Previously, they used to go long also by 200,000 contracts. Over here, they were very long, 250,000, 200,000. Suddenly, they don't go long. And in cash market also, they are only selling. That thing is in futures also reflecting. They don't go long much. Maximum long position here is not gone above 80, 90,000. One time, maybe 1 lakh contracts. And then it goes short again. So
So whatever the reading that we are seeing, that could be that could give a short-term bounce. But
short-term bounce for sure, but I cannot read into sentiment data for longer term sometimes, because in a bear market it will remain bearish. That's the main point. It has happened across data, like even in put call ratio, we noticed that when I published the put call ratio, the data has fallen a lot. Why? Because when market is falling, what is put call ratio? And we're talking of open interest put call. So open interest put call is not the volume traded, but the actual open interest. So what happens when market falls? People buy calls or people sell calls. Okay, writers keep selling calls. So they're selling so many calls that the PCR has gone below trend. So PCR is so below trend, you will say market is very oversold, which is sort of what I was saying in March. Sure, you got a rally, but point is the data is still down here only. So now the range is only changed. The range of the data is changing from a higher level to a lower level because you're going into a bear market is how I'm reading into it. And that can then be seen in historical context. See what happens. I'll actually try to push this into all the way back to 2. I'll put entire history of this data. We are trying to make all of this data available on Indiacharts through charts, scrollable charts. Okay. That's it. So then you'll actually be able to do it yourself and check yourself. Taking time, but we are getting that done. So now you're looking at, this is the open interest put call ratio. So you see it actually has cycles. Okay. Broadly, it remains in a range. We know that 1.2 is overbought, 0.8 is oversold and all that. But actually it has a range. It goes up during a bull market, then it curves down also, then it curves up again, then it curves down. Okay. So we had another curve down, which was going from 13, 14, 15. So for some reason it happens, either more call buying or call selling takes the put call ratio down. And there's more put selling during a bullish trend, the PCR moves up and so on and so forth. So we just have to get used to it. Right now, so if I look at this reading in general, I'll say, "Arey, ye to bahut oversold ho gaya." But it might remain down for a prolonged period of time. Like prior to this, in this Y2K prior period, it was very low, but then that's when options had just come into the country. So I don't know if it is comparable, but I think for the first time our data is going back down there.
Okay, right. And sorry to take time, just a quick question. So on the FII data itself, right, on the index side, they are net short, but on the stock side, they are net long. Does that mean anything?
I have not studied the stock side data, so I'm not able to comment on it because it used to be very small amount. And so I used to not look at it. Now it may be slightly more sizable, but I have not studied it.
Okay. Yeah. Thanks.
Okay, with this, the time has run out. Rohit, if you can just show where, those who have not, the questions which have been unanswered, you can just go to the website and you can post your questions. We'll be answering over there. It's only for the insiders, and you can also be a part of the insider club. Rohit, if you can just show the place where the questions can be answered. Yeah.
If on the strategy page, we'll also be posting the video, I think later on. The strategy page is right now open, but I don't think you can post without signing.
Yeah.
So if you just see the webinar page is here. Okay, so down here, of course, you can type a question and post it. We may not have been able to take all. There was one even which I got a long one on Twitter. Not really been able to answer. There are some in the comment section also here.
Okay, so you can just go and post your questions. I hope you understand. It's very difficult to answer everyone. So with this, let's wind up the long short webinar. Thank you so much, everyone. You can subscribe to Indiacharts and be an insider. You can go to indiacharts.com and open an account and subscribe for daily market analysis. With this, thank you so much. Take care. See you.